Dear ladies and gentlemen, welcome to the 4th biannual Macroprudential Policy Conference organized by the Bank of Lithuania. Despite the global adversities, it is our great pleasure and honor to invite us to this conference that we are holding here today virtually. This year, the conference focuses on the role of the borrower-based macroprudential policy measures in times of the global pandemic, the prospects, and for the future use of these measures. We are very pleased that many prominent academics and policymakers will be joining us today and tomorrow for very fruitful discussions. To open the conference, I would like to give the floor to the Chairman of the Board of the Bank of Lithuania, Mr. Gediminas Šimkus. Dear Governor, please, the floor is yours.
Good afternoon, ladies and gentlemen, and it's my pleasure to welcome you today to our Macroprudential Policy Conference, albeit not in our beautiful capital Vilnius, but still in an already traditional virtual format. And I would like to thank you all, speakers, panelists, and participants, for gathering to discuss this very timely topic, the role of borrower-based measures in times of a global pandemic crisis. I would like also to express my special thanks to our keynote speaker, Mrs. Sharon Donnery, Deputy Governor of the Central Bank of Ireland, who will deliver her keynote speech tomorrow morning. As this is already the 4th biannual Macroprudential Policy Conference organized by the Bank of Lithuania, allow me to bring some interesting historical context for today's discussions. When we started in 2015, we concentrated on the role and experience with credit flow restrictions and the effectiveness of borrower-based measures. 2 years later, we came up with a more controversial topic: should macroprudential policy target real estate prices, which ignited an interesting and sparkling discussions. In 2019, the topic of real estate taxation and its possible interlinkages with macropru policy led to the conclusion that the effective combination and coordination of real estate-related taxation and macropru policy should receive more attention from policymakers. The focus of the conference this year is once again on the housing market and emerging post-pandemic challenges. I would like to start my talk today with a quick overview of the topics we'll discuss this afternoon. And then I will present our Lithuanian experience of dealing with the housing market fluctuations during the COVID-19 pandemic. I will conclude with the insight into the 3 main challenges I see macroprudential policy is facing in the future. Dear colleagues, house prices are booming in almost every advanced economy as the impact of the coronavirus pandemic was weathered better than initially expected, in part due to forceful monetary and fiscal policy response to the pandemic. And it's hard to disagree with Claudio Borrow from the Bank for International Settlements, but in the short term, house price growth can be a good thing for the economy because people who already own homes feel richer and they can spend more due to the valuation of the assets. But at the same time, we should be wary of house price growth turning into the unsustainable boom. It's obvious that we do not want another credit-fueled housing price bubble, such as the one which led to a very painful burst in 2008. To this end, a set of properly calibrated macropru policy measures is the key to maintaining financial system resilience. In welcoming you all today, I hardly need to list the benefits of macroprudential policy and its instruments. It's widely acknowledged that by imposing additional regulatory requirements, macroprudential policy can restrain lending to excessively risky borrowers or create the necessary buffers in financial institutions. In other words, it can help to ensure that the financial system serves the real economy, instead of hindering its activity or amplifying shocks. Therefore, it's not at all surprising that after the great financial crisis, macroprudential policy gained relevance, becoming a mainstream, In fact, Lithuania was one of the first countries to introduce such measures back in 2011, and we believe these measures were crucial for building and maintaining sound lending practices. And nowadays, borrower-based measures are widely used not only in the EU but throughout the world. However, as we move into the post-pandemic new normal, we should be very wary of the new risks revealed by the COVID-19 crisis. We also need to carefully assess policies currently being applied to understand if they are sufficiently effective in the new environment. Therefore, I'm very happy to have you all gathered here to discuss how borrower-based measures should be adjusted in the light of recent developments. The period of COVID-19 pandemic was the first test of a framework in major economic crisis. I think everyone agrees that the framework passed the test successfully. However, some issues related to the framework's functioning in the medium term, namely its efficiency and transparency, have been revealed. As the EU-level discussions on possible minimum harmonization of borrower-based measures are currently ongoing, now it's a perfect time to evaluate the role of borrower-based measures played during the pandemic. We need to look further into what changes could be made to the macroprudential framework and its application to make it more effective, fair, and fit for the world of tomorrow. The European Commission is in the process of considering inclusion of borrower-based measures into the EU law by, first, introducing harmonized definitions, second, enhancing the availability of data needed for their effective application, and third, introducing a minimum harmonized borrower-based measure toolkit. While the consultations are ongoing, today we have a unique opportunity to discuss various experiences from a diverse set of countries such as Czech Republic, Denmark, and New Zealand. I'm especially excited to have Mr. Duncan Mills from the Reserve Bank of New Zealand with us today. Mr. Mills, I hope, will shed more light on the widely publicized decision to expand the monetary policy mandate, which now includes the task of supporting more sustainable house prices. In the euro area, housing prices are not part of the monetary policy targets, as residential property price changes are not included in the harmonized index of consumer prices, the most appropriate measure for assessing price stability. In the recent monetary policy strategy review of the European Central Bank, we recognized we need to include costs related to owner-occupied housing in the HSCP to better represent the inflation relevant to households. To date, the best tools we have in addressing the risks arising from housing market instabilities fall under the macroprudential framework. A central question we policymakers face today is how to respond to fluctuations in the housing credit market. Should we calibrate borrower-based measures with the aim to increase or decrease mortgage lending depending on where we are in the credit cycle? Ladies and gentlemen, I would like now to take an opportunity and share some insights about how the COVID-19 pandemic affected the Lithuanian housing market and how possible changes to the borrower-based measures here became a rather heated topic. So, when the first countrywide lockdown was imposed in the beginning of 2020, the Lithuanian housing market froze, transaction numbers plummeted, and the flow of housing credit diminished. This caused a lot of concern and sparked discussions on the need to loosen borrower-based measures to increase activity in the market. At that time, we allowed credit providers some flexibility when assessing the creditworthiness of individuals experiencing a temporary income drop during the lockdown. We basically chose a wait-and-see approach regarding more substantial changes to the borrower-based measures. It turned out that we were right in giving the market a minute to sort itself out. Only a few months later, buyers returned to the market with increased savings and craving newer, better, bigger housing. Months spent in lockdowns forced many households to reconsider their housing needs. When faced with a new reality of working from home, many found themselves in need of a dedicated room for a home office. Properties in less central but quieter, greener locations gained attractiveness in the absence of a daily commute. At the same time, many households, particularly those that were already wealthier, accumulated savings, as lockdowns limited spending while their jobs remained in demand and salaries increased. A combination of increased resources, accommodating financing conditions, and a shift in preference towards more spacious and comfortable housing sharply pushed demand for residential properties. And as we can see from the graph here on the left-hand side, after a sharp drop in transaction numbers in March-June 2020, housing market activity in Lithuania rapidly recovered and soon surpassed pre-pandemic transaction numbers. Again, the market slowed down during the period of a second nationwide lockdown at the end of 2020, but this dip in market activity was neither as deep nor as prolonged as that at the onset of the pandemic. With demand for housing high and supply limited, given that acquiring suitable land, obtaining building permits, and ensuring building supplies, housing price growth in Lithuania picked up, reaching 13.3% in the second quarter 2021, the most rapid increase since early 2008. At the same time, as you can see in the graph on the right-hand side, the share of lenders' portfolio allocated to mortgages continued to increase, with the pace picking up visibly in the recent months. And now, only a year after intense discussions on possible loosening of borrower-based measures, we are considering tightening them. After thorough microdata analysis and econometric modeling, we have concluded that there is a need to target a riskier segment of the housing market, those acquiring second or subsequent loans for housing purchases. During the pandemic in Lithuania, the share of loans to borrowers who already have a mortgage increased, as illustrated by a graph on the slide. The share of non-primary mortgages particularly increased for housing located in our lovely capital city Vilnius and in the recreational seaside region, from roughly a 10th to 16% of the total mortgage flow, pointing to possibly speculative housing purchases with credit. To tame such behavior, we have decided to impose a stricter loan-to-value requirement for all second and subsequent mortgages, except to those borrowers whose primary loans are significantly amortized. In addition to this, we plan to introduce a sectoral systemic risk buffer requirement to banks and credit union groups operating in Lithuania, applicable to their overall mortgage portfolio, and this sectoral systemic risk buffer would contribute to financial sector resilience to housing market turbulence. The official decisions will be made after ongoing consultations with market participants, VCB and other authorities, and these measures will come into force next year. At the same time, to discipline speculative tendencies in the housing market in general, our government is also considering revising its real estate taxation policy. Proposals currently focus on increasing taxation for those owning multiple residential properties, rather than on taxing properties only in situations where property value exceeds a certain threshold. If implemented, such fiscal policies, in combination with intended changes in the borrower-based measures, would have an impact in cooling the currently heated housing market. If fiscal and macroprudential policy work together, they have the potential to achieve its maximum effect. But let me return to the status quo. And the currently binding framework for housing loans in Lithuania is very well summarized in this slide. We have an LTV limit of 85%, debt service to income ratio of 40%, and maximum mortgage maturity of 30 years. This framework helped in creating a level playing field for mortgage lenders and propagated more prudent lending and borrowing practices since 2011. The world today, however, is not the one that we had in 2011. Therefore, we gather here not only to share our experiences and views on current borrower-based measures, but also to look ahead and consider possible enhancements to the use of macroprudential policy instruments and policies in the future. Dear colleagues, I mentioned in the beginning, I see three main challenges we must consider when revising the macroprudential policy framework. First, we need to consider the effectiveness of macroprudential instruments to tackle systemic risks arising from the low interest rate environment. Second, we need to think how to minimize distributional consequences of the borrower-based measures. And third, we need to investigate to what extent macroprudential instruments can mitigate climate change risks. Regarding the first challenge, no EU member state so far has explicitly used macroprudential instruments motivated by systemic risks related to the low interest rate environment. This is partly because the current macroprudential framework and the available macroprudential instruments do not facilitate efficient mitigation of such risks as low profitability and the resulting search for yield behavior. Borrower-based instruments are currently available only for lending to households, not for lending to non-financial corporates. In the few countries that have developed borrower-based measures targeting lending to corporates, they apply it exclusively in relation to commercial real estate transactions. In addition, borrower-based instruments often do not cover all lenders, including non-bank financial institutions. However, while we all mostly agree that we should expand macroprudential instruments to cover all lenders beyond the banking sector, opinions differ regarding whether borrower-based measures should be applied to lending to companies. As I mentioned before, the European Commission is currently considering the need to expand applicability of borrower-based measures to include lending to companies. It is therefore very timely that in the policy panel tomorrow we will have an opportunity to seek further insights on this issue. The second challenge we must consider is the widening inequality of households' income and wealth. Borrower-based measures have distributional effects and may potentially impact wealth inequality, given that, depending on the design, borrower-based instruments may limit possibilities to own housing for certain groups of individuals. In our discussion tomorrow, we will share opinions on how the framework of borrower-based measures can be calibrated or augmented to minimize this undesirable side effect. An effective combination and coordination of real estate-related taxation and macropru policy is necessary to ensure that the limitations to home ownership are as closely related to the riskiness of individuals as possible. And finally, climate change risks are very real, and their importance increases each day. Macroprudential policy measures have the potential to mitigate climate change-related risks to financial stability and to contribute to greening the stock of available housing. By differentiating borrower-based measures according to some characteristics of the housing unit, for example, more stringent loan-to-value requirements for loans secured by old low-energy performance housing units, or for units at increased risks of flooding from rising sea levels areas, we could impact the attractiveness of such housing types and their affordability. There is no better time than the present to consider whether we should introduce such changes. I also strongly believe that now is the time to discuss whether macroprudential policymakers are prepared and whether they have the necessary tools to mitigate climate-related risks to financial stability. It's worth noting that we still lack clear evidence on the degree to which the macroprudential policy measures address these risks, especially when interactions with other policy areas are accounted for. To wrap up, this is the fourth Macroprudential Conference, and I'm very glad to see that the agenda is filled with interesting sessions with speakers from many different institutions all over the world. And I wish us a fruitful exchange of views, hopefully leading to constructive policy outcomes. And now I'm excited to open the floor to these highly needed and well-targeted discussions. Thank you.
Dear Governor, thank you very much for your speech. As such, I would like to take this opportunity and welcome and introduce the first session of this conference. And this session will be focusing on the application of the Borrower-based macroprudential policy measures through the cycle. And for the viewers, I would like to remind them that they are able to ask questions in the comment box that can be found on the website of the Bank of Lithuania, which is www.lb.lt. And if you like a question that has been asked by another viewer, you can press the like button and this question will appear up front. So without further ado, I would like to open the first session, and I would like to invite the first speaker, Mr. Erlen Nier, who is the Deputy Division Chief of the Monetary and Macroprudential Policies Division of the International Monetary Fund. Mr. Nier, in this position for many years, has been leading the fund's policies development in the area of macroprudential policy. Mr. Nier, I'm aware that it's a very early morning in Washington, D.C. We're very pleased to have you here today. Please, the floor is yours.
Back to the conference in Lithuania. Let me start. I hope you can see my screen and my my picture as well. Let me start with a summary of the main messages that I have for you today. The first point I'd like to make is that borrower-based tools belong in the time dimension and seek to attain objectives in that time dimension. The second point I'd like to bring home is that new research that we've conducted at the IMF shows that the desired transmission to objectives in that time dimension is working. Third point is that while some tools, especially loan-to-income ratio tools, can work as automatic stabilizers, it's generally useful to tighten borrower-based tools in response to easy financial conditions. And that's, in fact, what is shown by the research I'm going to talk about in a little bit. And the final point here is that borrower-based tools can also be relaxed when they come to impede the desired provision of credit. So objectives in the time dimension. We think, and I think, that borrower-based macroprudential tools can contribute to the intermediate objectives that we have set out for tools in the time dimension. They can contain the buildup of systemic vulnerabilities over time by reducing procyclical feedback between asset prices and credit and containing unsustainable increases in leverage. And they can also increase financial resilience to aggregate shock by building buffers that help contain macro financial feedback in downturns and support the provision of credit under adverse conditions. So that is to say that these borrower-based tools are not meant to aim to control structural vulnerabilities within the financial system that come from interlinkages. On the other hand, a contribution to objectives in the time dimension does not require for tools to be moved frequently. So we don't have to move these borrower-based tools all the time for them to be useful to contain risks across time. The transmission towards these intermediate objectives, I think it's useful to see how they can ultimately reduce tail risks to output. And in fact, reducing tail risks to output, you can think of essentially as the ultimate objective of macroprudential policy tools. And it's quite clear, I think, conceptually how borrower-based tools can work towards that objective. So they can contain the buildup of systemic vulnerabilities over time, but they can also increase financial resilience. I'm sure it's well known to everyone that they can reduce borrowers' probability of default in the event of adverse shocks. They can reduce loss in the event of default. And they can also reduce a cutback in consumption from borrowers trying to maintain debt service in bad times. So all these mechanisms, I would argue, contribute to the ultimate objective, which is to reduce downside risks to GDP. And I'm stressing that point in part because this relates closely to some work we've conducted recently at the IMF. It's joined with Luis Brandão, Gaston Gelos, Machiko Narita, and where we assess the effectiveness of borrower-based and other policy tools in reducing downside risks to the GDP. So we're asking essentially, are these measures able to attain or contribute to this ultimate objective of reducing downside risks, tail risks to GDP? The starting point for that research is a trade-off that arises when you have, loosening financial conditions today, and that can, boost GDP today, but that also increases downside risks to GDP further down the road. And we examine the interaction of the effect on GDP from between financial conditions and policy levers. So what happens if financial conditions loosen, but you essentially lean against this using policy levers such as macroprudential tools, such as borrower-based measures. In that research, we're careful to think about how to address endogeneity of policy levers, because it's quite clear that, perhaps on average, you would see that policy levers are used in response to changes to financial conditions. So we need to account for that. And we go further than the sort of growth at risk literature by calculating the effect of policy on the entire distribution of future GDP. So we're not looking just into the tails, but we're computing policy effects based on the entire distribution of future GDP. And the key finding that we have, and that I have for you, is that in response to easing financial conditions, it is the case that tail risks to output are magnified. But it's also true that borrower-based tools can reduce that increase in risk. And I wanted to maybe take 5 minutes to give you a little bit more of a flavor of this research. So here is essentially a picture of what happens to GDP growth as a result of an increase in sort of a loosening of financial conditions. Again, the idea being immediately you get a boost to GDP. That's the blue line at the very start. But then as time goes on, that positive effect reverses, and you get more of a tail risk to GDP, where GDP growth is lower. Let's say two years down the road. And what we're interested to look at here is using quantile regressions, whether we find that not only that we have these effects of financial conditions, but also whether policy variables can affect that influence of financial conditions. We do this in a sample of 37 countries, advanced and emerging economies, and we look over essentially 26 years of data at the quarterly frequency of macroprudential policy measures being taken, financial conditions changing, and GDP moving as well. As I said, we need to distill, we need to treat endogeneity, and we do this by distilling policy shocks. So we estimate a probit model of whether or not policy authorities are taking action based on key indicators that we tend to use, the credit to GDP gap, house price gap, and indicators of lagged policy actions. And then we use not the indicator, but the policy shock, which is defined as the difference between the actual policy indicator of macroprudential action and the conditional expectation of that policy indicator based on the probit regression. As I said, we look beyond just the tail of the distribution, and we look at the whole distribution at any given horizon, where you see from this picture that what might happen is that a loosening of the financial conditions may give you a flatter distribution of output growth in the medium term. That's the so we're moving towards the red curve which has fatter tails, and then you might hope that policy can pull in that distribution again, pulling in the tails of the distribution. But that may also shift the mean of the distribution, perhaps further to the left, so that you have policy costs. So that would be moving from the red curve here to the blue curve, which is less fat, but it has a mean that essentially amounts to the cost of taking policy action today. And so what we do is we compute the net benefit of policy action across this whole distribution. We integrate across the whole distribution. And we compute loss functions that take account of these distributions as they evolve through time by first obtaining the conditional variance of GDP growth at each horizon. Again, we're looking out 14 quarters out. We're taking the conditional variance of GDP growth at each horizon. We use these conditional variances to essentially feed a quadratic loss function. And we then take the overall loss to be the discounted present value of essentially the variances of GDP growth over the whole horizon. And we then compare the loss functions with and without policy action. And that brings us to the key results of this research, which is that when facing a loosening shock to domestic financial conditions, a tightening of macroprudential measures has substantial net benefits. So as you can see here from the numbers, on average, a tightening of macroprudential measures in response to a loosening of financial conditions will reduce losses. So will have a net benefit by reducing the loss function by something like 8%. And that's true for any macroprudential measure. But it's also true, and perhaps more so, for the borrower-based measures. Overall, we find borrower-based measures to have a slightly larger effect in terms of reducing losses, in terms of their net benefit, than financial institutions-based measures, which is sort of short for capital requirements here. And in fact, we find that the net benefit of these macroprudential actions is positive, which is not the case for monetary policy tightening in the event of loosening financial conditions, sort of interestingly. So the punchline of this research is to say, if you want to lean against the wind of loosening financial conditions, use macroprudential policy measures rather than monetary policy. We find that the net benefit of borrower-based tools in particular are strong when credit and asset prices are high. As you can see here in the right-hand side table, when credit as measured by the credit to GDP gap is high, we find that these net benefits of borrower-based tools are pronounced, whereas the net benefits of the financial institutions-based, so the capital measures, are no longer very strong. So in an environment of high, and the same is true of asset prices. So in an environment of high credit, high asset prices, borrower-based tools have the strongest net benefit. That essentially tells us that it's useful to tighten macroprudential policy measures, and in particular borrower-based tools, in the event or in response to changing financial conditions, rather than having them sit idle. It's useful to think about tightening and loosening of macroprudential policy measures in response to changes in financial conditions. So how would that work in practice? Here, I think, from a policy perspective, it's worth acknowledging that some borrower-based tools can work as automatic stabilizers, while others would need to be more actively varied cyclically. So in particular, the LTI tool can anchor debt to income levels and can therefore act as an automatic stabilizer. It's probably well known to most of you as a concept. The LTI was introduced in Ireland, for instance, in 2015, and they've since not been seen a need to change that LTI. LTV, on the other hand, may need to be varied cyclically to maintain policy effects when asset prices rise. And we have many examples of countries who are using the LTV in that kind of active fashion. So New Zealand is an example, Korea, Singapore, Hong Kong. In all of these countries, essentially the tool is varied in response to changes in financial conditions and house prices, and often by tightening constraints on the more speculative purchases. The debt service to income ratio cap is a third type of tool, which may need to be tightened in particular if interest rates are low or lower than average, unless, of course, the DSTI ratio cap itself is stressed, as it is in some countries, not in all countries, but I think Canada and Hong Kong, again, are a nice example of having a built-in stress into the debt service to income ratio cap. In the event that financial conditions are strong, it's also useful to assess how well the tool is working. Often what authorities find is that when financial conditions are easy and credit growth is sort of buoyant, under those conditions you find that there is a leakage of the macroprudential policy measures, and you need to expand coverage of the measures to non-bank providers of credit, as has been done in a number of countries. Korea, Singapore, and Romania are good examples of this. But also, you may want to, feel forced to, expand the scope of application of the measure by including all types of household debt, not just the mortgages, to create what's known as total debt service ratio caps. And again, Korea and Singapore, as well as Romania, are good examples of having these kind of total debt service ratio caps. And they're useful to maintain effectiveness through buoyant conditions. There's on the other hand also scope to relax borrow-based tools in downturns. And as many of you know, this has happened in the COVID crisis. Examples are Finland, Israel, and New Zealand. And we have a quote here from the Reserve Bank of New Zealand, which we sort of looked at earlier on. They loosened their LTV constraint back in April 2020. So what are the principles and trade-offs here? The first point is that a relaxation of these borrow-based tools is more useful the more the macroprudential constraint is binding on the provision of credit. So if the constraint isn't binding on anyone, then a relaxation of the tool isn't going to have much of an effect. But this is where this quote comes in. So the Reserve Bank of New Zealand did think that it was worth removing the LTV constraint because it might be binding and become an obstacle to the flow of credit in the economy. So they wanted to remove the constraint in the event that it could become an obstacle, and so that they could support the provision of credit to borrowers. Of course, a relaxation of borrow-based tools such as LTV can be particularly helpful if it sort of follows a previous tightening of the LTV. So in the previous sort of buoyant conditions, you might have tightened the constraint several times, and then in the event of an adverse shock, you can then more safely dial back that tightening. So you can essentially create policy space for a relaxation without making the constraint excessively loose. And I think Finland is a nice example of that, where they've tightened the LTV from 90% to sort of tighter levels in sort of good times. And then when the COVID crisis hit, they loosened it, and it went back to 90%. So using the policy space that was given to the financial authorities in Finland. I would like to close by just stressing that in the current conjuncture, in many countries, I think the stance should return to tightening. The trade-offs, and I think it's been mentioned in the introduction, now point to tightening in a number of countries for two reasons. One is the COVID preference shock, where many households have developed a preference for spending more on housing services, having bigger houses, having a yard, having these kinds of properties around them as a result of the COVID experience. That pushes up prices. The second point is, of course, that there is easy monetary conditions pretty much everywhere, certainly in the advanced economies, and that combines to leading to strong increases in household household debt as mortgages take advantage of the low interest rates. So as a result, there is a risk that borrowers are now overextending themselves, taking on too much debt in this environment to purchase ever bigger properties at high prices, and to maintain the ability of borrowers to service that debt, even as interest rates may rise in future. I think, and we think, it's important to consider whether borrower-based tools should be tightened in this conjuncture, unless, of course, you are sort of fortunate enough to have an LTI constraint in place, and that's thought to be working well. So again, it may be. So here, the final point I'd like to make is that politically, of course, sometimes it can be tough to tighten these borrower-based tools, in particular when asset prices are already high, because then you'll get a lot of pushback from borrowers and perhaps politicians who will complain that you are further reducing affordability for borrowers. So from that perspective, tightening when asset prices are already sky high is not going to be easy politically. And it may be better to have tightened or at least introduced the constraints in times where asset prices are relatively low and people have no problem taking on debt, buying property, so that you introduce the constraint at a point when actually it's not binding on anyone. That can help you, I think, a lot, because the tool then works to keep borrower debt service ratios sustainable through time. And that's all I have. There are references here to the main papers I've been talking about. Thank you very much.
Thank you very much, Mr. Nier. It is my great pleasure to introduce the second panelist, Mr. Marek Liček from the National Bank of Slovakia. Mr. Marek Liček is the director of the Financial Stability Department and has been working in the central bank for the past 20 years. He has an extensive experience in leading the analysis of the systemic risks in the Slovak financial system, as well as leading the implementation of macroprudential policies. Mr. Liček, please, the floor is yours.
So good afternoon to everybody. I hope you can hear me and see me now. Sandra, first of all, thank you for a very kind introduction. I'm also very glad that I can be here. Unfortunately, it's not in Vilnius. Vilnius is a beautiful city, so I hope that next time when there will be conference, it will be final with physical presence. Let me also thanks to colleagues from Bank of Lithuania, because I know that this conference has a very good reputation, is very good. So I'm very glad that I can I can be here. And I remember also that Mr. Governor has a first speech, and I'm glad that he is here because he also very good expert on macroprudential policy. So I'm glad that he will be also part of our discussions. Well, the topic that you opened on this conference, I think, is very important. Cyclicality of borrow-based measures. I remember many conferences, many speeches about cyclicality of capital measures, mainly CCYB, but not so much about borrow-based measures. And I think it's very important because now finally we have experience with the full cycle, so not just with the tightening as it was before the COVID-19, but now we also have some experience with the easing. I think the previous presentation by Alan was very comprehensive. He covered many aspects of the borrow-based measures. He covered tightening. He was speaking also something about the easing. He also mentioned effectiveness. So that was very interesting. My presentation is focused on one specific area, and it's easing of borrow-based measures. Because as I mentioned, we have relatively good and let's say already rich experience with the tightening, because during the previous decades, many countries tighten borrow-based measures. They tighten it even several times. So that means that there is already some kind of cyclicality, so reaction to changes in the market, but not so much. We don't have so much experience with the easing. Maybe it's driven by the fact that in most countries, macroprudential framework was introduced just after great financial crisis, and there was just this expansionary phase of the cycle, and we have just this small experience with this COVID crisis. That's a very specific crisis. I will speak about this later on. So there is not so much experience. And frankly speaking, we have not reacted during the latest crisis with the easing, despite the fact that before the crisis we were quite active in the tightening. But this topic was on the table, and we had a lot of internal discussions within the bank, and we found that it's a very important topic and not so easy topic, because you have to take many factors into account, and what we can see that it's definitely not symmetrical picture. So it's not, you cannot use the same arguments, the same factors as used for the tightening. So I won't have a very long presentation, but please take it like bringing some new ideas, or bringing our view on how we approach this question of the easing of borrow-based measure during the crisis. And I hope that my thoughts can contribute to this conference. And I'm looking forward for discussion, because I hope that even other colleagues can enter discussion and share the experience with easing of borrow-based measures. Okay, so let's start. Normally we still have. Can you see the second slide, please? Hello, I'm glad I'm back, and I'm sorry for some technical problems, but there was a problem with sharing my presentation. So let's move to first slide, and I will try to speed up a little bit the whole presentation. So that's a first view, how different countries reacted to the borrow-based measures. So you see on the left side picture where you see 35 advanced economies. On the right side you have all European countries, and basically you have all actions that were done with borrow-based measures. I already mentioned that authorities start to be more active after global financial crisis, because at that time or after the crisis, most countries implemented macroprudential framework. So that's why you see this jump on this picture. But what is very interesting that you see that tightening was much more prevailing, was more often present in the policy of central banks than easing. So that's a very important, because I will try to answer this question, why it is present, but that means that there is a certain level of cyclicality. I haven't analyzed individual countries, but there are definitely countries that tightened borrow-based measures several times. Some countries tightened just 1 or 2 times, then they release. So you have many individual cases, but you see that there are significant differences between the countries. Okay, let's move to next slide. I hope you can see. So the question is why authorities are prone to do tightening more than easing. Well, I think the question or the answer is very simple, because our responsibility as a macroprudential authority is responsibility for the resilience of the banking sector. So that means that banking sector should be stable over the whole cycle. But we know from the past crises that, especially during the expansion phase, there is a clear tendency to underestimate its risk, whether it's from bank side or client side. So during the expansion phase, you can have a very strong credit, you can have a very strong residential market, you can have a very optimistic market driven also by the low default. And we know from the past, especially during this expansion phase, banks can make a lot of mistakes, and of course, then resilience is at the stake mainly during the contraction phase. So it's very clear that during this expansion phase, we should be active and we should do something, because that's our responsibility to smooth the whole financial cycle and make banks ready for the contraction phase. The question is how we should react during the contraction phase. So should we simply symmetrically release borrow-based measures, or should we be more cautious? Well, there is no clear answer about this, but what we know from the latest experience, that during the latest crisis, when there was this economic downturn, many institutions were quite active to do something with the situation. We know that governments were very dramatically involved in supporting economic recovery, and basically they cover all losses that were present. And thanks to this involvement, we saw relatively V-shaped recovery economy. Also, monetary policy was quite active, so they introduced some new measure to support recovery. Also, macroprudential authorities were quite active. They released capital requirements for the banks. So the question is, should we also contribute to this general effort to do something with the recovery, or should we simply say no, it's not our business, because we are focused mainly on the expansion phase to reduce accumulation of the risk, or prepare banks for the bad times by increasing resilience, or should we also contribute to this effort? And that's a very important question, and I guess that many central banks are facing this question during the latest crisis. Even in our case, there was certain pressure. There was certain pressure because there was this, let's say, action bias. So many institutions were quite active, and there were also questions on our central bank. Okay, you see that everybody is doing something, so why don't you do something with borrow-based measures? We were relatively quick in terms of capital measures, so we also reduced CCYB, but in case of borrow-based measures, situation was slightly different, maybe much more cautious. about this. So here probably the major question that is on the table and was on the table in our case was, should we, let's say, support, we call it secondary objective, so to support credit or economic growth by the releasing borrow-based measures, or should we simply say, no, we don't want to increase in the risk in the bank's portfolio, so that means we don't want any significant increase in the future losses. So that was the question that we were facing, and I will show you how we reacted to this situation. So when is the time for easing? You remember this picture where I showed the whole cycle, and I showed that during the expansionary phase, it's normal that we do some tightening because we need to tackle build-up of the risk and to increase resilience of those households. But again, there is a very different situation during the downturn, because at that time situation is absolutely opposite. There is a huge uncertainty, and that's basically the word that describes this contractionary phase, because you are in the position where you see that something is happening, you see that economy is doing very bad, it's decreasing, you see negative development on the residential market and also on the lending market, and you are still in, let's say, some uncertainty about the length of the overall crisis and also about the depth of the overall crisis. So how much losses you can still expect. So here probably one of the crucial questions is for us as macroprudential authorities whether there was already materialization of the risk. So normally in the early phase of the crisis, when there is a huge uncertainty and real estate prices are still relatively high, so there is just small decrease of the prices or small decrease in the income, that's the situation where we do not see sufficient risk materialization. So imagine that at that time you, for example, release borrow-based measures, for example, LTV, when you reduce or so when you increase LTV from 80 to 90, and at the same time, if you have further decrease of real estate prices, for example, by 20%, that would mean that basically this decrease in the prices deplete your buffer in LTVs, in new loans. So probably it's not really the best idea, at least from our perspective, to release borrow-based measures in this very early stage of the crisis, because there is still high uncertainty about the future development and the risk is still present. So probably the best time when we can think about releasing buffers is when there is, we call it so-called early phase of recovery. So when risk is already materialized, so there is a decrease in the real estate prices, also in the income, and we know that now we are at the beginning of the new cycle, so we see already some light at the end of the tunnel. Probably this is the time when we can think about some relaxation of borrow-based measure. Of course, it very much also depends on the shape of this recovery. So if it's a V-shaped recovery, as we saw during the latest crisis, probably there is not so much need to support lending, because that means that demand is relatively strong. Even banks released lending standards. So that means that our help is probably not so much needed. But if there is a recovery in the L shape, that means that there is certain space for our contribution to the recovery. So let's move to next slide. And of course, there is also a very interesting question: which tools are probably the best candidates for the releasing or for cyclicality? Probably there is no simple answer for this, because even in Europe, where we have a quite close links between different authorities, and even the overall framework is quite similar, I think we see significant differences how borrow-based measures are defined in our legislation. Even objectives can be very different. Just to give you an example, probably DSTI in Slovakia is very different than DSTI in Norway or Lithuania, because, for example, when we define income, we take income, but we also did that minimum subsistence, so the minimum living standards for each client. And that means basically that this DSTI is more constrained for lower income categories. And that was basically even our objectives, to introduce DSTI to tackle risk related to lower income categories. And I can imagine the same with LTV. Is very different in Slovakia and in other countries because there are many small changes in the definitions. But from theoretical point of view, probably the best candidate should be LTV. And the reason is very simple because LTV is related to real estate market. So basically by imposing LTV, you set certain buffer in relation to real estate market. And we know from the past that the real estate market can be relatively volatile, especially in some areas. So once there is this volatility, you can, of course, be more active in the tightening. But once you're in a situation where risk has been already materialized during the crisis or after the crisis, then you can maybe do some easing in the LTV because you simply assume the real estate prices will go up and buffer will stay in your regulation. In terms of DSTI requirements, I would assume that this should be more stable because again it's related to income and labor markets, so we should not expect the same level of volatility. But I know that during the latest crisis, several countries released also DSTI, and basically they assume that there is some temporary decrease in the income. So once you have this assumption, this could be a reason for the relaxation of DSTI. And actually, what was surprising for me, if I'm coming back to my first slide, where I had evidence from different countries, that despite this theory that LTV should be more cyclical than DSTI, we see that in most countries, DSTI relaxation was more present than LTV relaxation. I don't have a clear answer for this because, as I mentioned, I haven't analyzed cases of individual countries. But especially in Europe, relaxation of DSTI was much more present. Also, it's very important to mention exemptions. In Slovakia, but I believe it's also in other countries, when we defined or when we set borrow-based measures like LTV DSTI, we set some basic level like 60 for DSTI or 80 for LTV, but also we introduced exemptions. And based on our definition, we basically define it like this basic level or basic limit is more structural, but we can understand these exemptions like more cyclical. So if you're thinking about relaxation of borrow-based measures, probably relaxation of the exemption can be a good candidate. Let me also mention links between relaxation of borrow-based measure and also other measures, mainly capital-based measures, and here probably mainly CCYB. I already mentioned that in Slovakia, but I guess it's not just Slovakia, but also other countries reacted relatively quickly to this new COVID-19 crisis, and they relatively quickly reduced capital required, mainly CCYB, also buffers for systemic relevance. This can help. Of course, this can offset certain cyclicality in borrow-based measures, but again, it depends. It depends on every specific case. What we have learned so far that what is crucial in this context in finding this overlap is to what extent banks are constrained by the capital. So if there is no capital constraint in the banking sector, and even if you reduce CCYB, probably it has no impact on the lending, and basically you do not offset any cyclicality in borrow-based measures. But I can imagine in countries where banks are capital constrained, any reduction in capital requirements can have this offsetting impact on borrow-based measures. And of course, let me also mention that when you are thinking about easing of borrow-based measures, it's also very important what is the capital position of the banks, because it's of course much easier to think about easing borrow-based measure when the whole banking sector has a relatively strong capital position. Okay, let me move to the next slide. So I have already mentioned several factors that can contribute to this discussion about easing of borrow-based measures. what is also very important, because one of the previous slides I mentioned this balance between potential losses in the future and supporting current recovery. Well, we can have, of course, different views and also general discussion how we should weight both factors. But what is really crucial here is to have some data or some results from the analysis and some quantification about impact of the easing of borrow-based measures on certain risk indicators. Because if you don't have the data and all those analyses, then it's quite difficult discussion, and there can be many political pressures. So what we found very useful to run so-called counterfactual analysis. So you can find a link on this slide, and basically that's an approach that was done also with the IMF and the ECB, and that means that we basically try to analyze impact of different levels of borrow-based measures like LTV, DTI, DSTI, and we try to analyze impact on different risk indicators. So, for example, this example, you see the impact of different level of borrow-based measures on the new lending, expected loss, PD, or loss given default. So, thanks to this approach, we are able to analyze how much risk we are willing to flow into banks' portfolio. So that's a very useful tool, and I really encourage you to open this link and to study it. Okay, and the last slide is about real example. So how we approach easing and this question about the easing during the last crisis. Well, you already see the results. So there was no easing of borrow-based measures, but maybe the story can be also interesting for you. So I already mentioned that from the very beginning there was a pressure to do something. Politicians ask, journalists ask about this. Okay, why don't you do anything about this? Look around you. Everybody's do something. So there was this pressure. But as I mentioned at the beginning, from the very beginning of the crisis, there was relatively huge uncertainty, and at this time there was basically no pressure from the banks, and also there was no demand. But after several months or quarters, situation improved significantly. When we discussed this internally, we were very clear that probably it's not a good time to easy borrow-based measure, especially during the first phase when there was a huge uncertainty. But of course, potential easing was on the table in the next phase. But again, when you see the figures that are on this picture, you see that basically there was no real need for the easing because credit growth was still relatively strong. Of course, there was some stagnation in the first phase of the crisis, but just after this first phase, already in September, October, there was a V-shaped recovery and credit growth increased relatively significantly. The same with the real estate market. Also, when we discussed with banks this topic, at the first stage, there was no pressure because banks were quite cautious, even more cautious than our rules. So there was no pressure. Of course, there was some pressure after this first recovery, but we were very clear that, okay, once there is this strong credit, there is no need to support you in this case. And also we did a lot of analysis and also counterfactual analysis that confirmed basically the borrow-based measures were set up properly and were basically set up at the breaking level for higher and lower risk. There was a discussion mainly about DTI and some exemption for DTI limits, because DTI limit is in our case set mainly for higher income categories, and the objective behind was related to increase was related to indebtedness, but then we concluded that it's probably not necessary because the situation was relatively good on the market. Okay, I think I will stop here, and I'm looking forward for your questions. Thank you.
Mr. Lichak, thank you very much for your very interesting presentation. And I would like to also apologize to you and to the viewers for the technical difficulties experienced. Let me now invite the third presenter, the third panelist, Mr. Torbjørn Hægeland, who is the Financial Stability Director at Norges Bank. Prior to joining the Norges Bank, Mr. Hægeland was a Director of Research at Norway Statistics, and he has more than 20 years of experience in economic research. Mr. Hægeland also holds a PhD in economics from the University of Oslo. Mr. Hægeland, my great pleasure. Please, the floor is yours.
Thank you. Before I start, I would like to thank the organizer for inviting me to this conference again and for the opportunity to share with you Norges Bank's views on and experience with borrower-based measures. I've been challenged to cover a number of important and interesting topics, but I will concentrate on what I see as the main topic, namely, should the calibration of borrower-based measures evolve during the credit and housing market cycle, or should these measures primarily be structural measures? I will in addition touch upon two additional topics. What factors and indicators should be taken into account in the cyclical or structural application of BBMs? And second, should we differentiate BBMs across groups of borrowers and geographical locations? I will also share what I think of as takeaways from the Norwegian experience. There are two important questions that I think the implementation and calibration of BBMs should depend on. First, the motivations for the BBMs. Why are the measures put in place? What is the objective? And second, how the measures work. Ideally, we should understand both direct and indirect effects, the measure's effectiveness, and also how combinations of measures work. I need to explain that by structural regulation, I think of a regulation where the requirements are fixed or quasi-fixed over time, that is, over the credit and house price cycle. While by a cyclical regulation, I think of requirements that vary over the economic cycle. That said, a structural regulation with fixed requirements is likely to have cyclical effects. I will talk more about this later. If the motivations for BBMs is to tame the credit or the house price cycle, then they are cyclical measures and thus call for a cyclical calibration of the requirements. The relevant indicators are cyclical. In assessments of cyclical risk, Norges Bank primarily monitors developments in credit and house prices, different transformations of these variables, and how they relate to developments in GDP. If the aim is to limit the buildup of household sectoral vulnerabilities, then BBMs are structural measures and call for structural calibration. The relevant indicators for calibration in the structural case are indicators that reflect household vulnerabilities. And to this end, we follow a set of indicators based on full coverage household level data. We have developed indicators to help us assess vulnerable households and to follow the share of debt held by these households. A third possible motivation for BBMs is consumer protection. In this case, we could monitor indicators similar to those relevant for the assessment of household vulnerability. Also, this motivation calls for structural calibrations. Other motivations than these three are also conceivable. For example, one motivation could be to accommodate first-time homebuyers at the expense of secondary homebuyers. In this case, it can also be argued that the calibration should be structural. I will now turn to the question of how BBMs work. As with most regulations, BBMs come with both benefits and costs. I will first concentrate on the benefits, how the measures support the objectives. BBMs work through the limits for prudent credit standards for mortgage lending. This may affect both credit and house prices as well as household sector vulnerability. Empirical analysis find that BBMs, these imposed limits for credit standards, do affect credit growth and house price inflation. Most studies look at rates of increase before and after the introduction or tightening of BBMs, and they provide information on the effect in the shorter run. There is less evidence on the long run effect. However, results across studies are heterogeneous and therefore provide a limited basis for the calibration of the BBMs. To my knowledge, there is less empirical evidence on BBM's effect on household sector vulnerability. There are fewer relevant studies covering this issue. Later in my presentation, I will show some experience from the Norwegian case. I see three possible reasons why there are fewer studies of the effect on household sector vulnerability. First, the macroprudential motivation for implementing BBMs has often been cyclical, that is, to tame the house price and credit cycle. Second, household sector vulnerability evolves more slowly, and effects may be harder to identify. And third, data availability is in many cases scarce. Turning now to the cost side of BBMs. This type of regulation implies regulation of credit standards. However, standardized requirements may have an undesirable impact in individual cases, limiting some low-risk loans. Stringent credit standards regulations leaves less room for judgment in banks' credit provision and can weaken banks' incentive to take independent responsibility for assessing risk. And it may also cause leakages, circumvention, and credit growth from unregulated sources. This regulation therefore comes with a gross efficiency loss. I expect that the more binding the BBMs are, the larger the costs. Furthermore, the BBMs are likely to be more binding when house price and credit rise more rapidly than income. The costs are therefore likely to be cyclical, but so are also the gains. And the more binding the BBMs are, the stronger I expect the effect on house prices and credit to be. I should explain that Norges Bank's role related to BBMs is to give the Ministry of Finance and also the FSA of Norway policy advice and to perform a relevant analysis. We don't have any decision-making power regarding BBMs. Norges Bank's view and recommendation with respect to borrower-based measures is that they should be implemented as a structural regulation with quasi-fixed restrictions and a flexibility quota, known also as a speed limit. Quasi-fixed requirements implies that the requirements could be adjusted if needed, but we argue against changing the requirements frequently over the cycle. Our experience is, however, that by the recommended design, the regulation has both structural and cyclical effects and benefits. The cyclical effects come from the cyclicality in the degree to which the requirements are binding. I would also like to point out that by keeping requirements fixed over time, any feeling of regulatory unfairness across both cohorts would hopefully be reduced. That should also help making the regulation more acceptable, which is, of course, is important in order to ensure long-term beneficial effects. Furthermore, a flexibility quota enables banks to grant loans that exceed the requirements based on a customer-specific assessment. A flexibility quota underpins banks' own responsibility for prudent credit standards. In this way, the regulation strikes a balance between the aim of credit market efficiency and the aim of mitigating the buildup of risk in the financial system. I would like to point out that the existence of a flexibility quota gives us an instrument to adjust the tightness of the regulation in accordance with the evolution of risks in the financial system. And this adjustment is achieved at the same time as the gross requirements are kept unchanged. I should underline, however, that Norges Bank has argued strongly against using BBMs, including the flexibility quota, to fine-tune development in credit and house prices. Intervention in the markets with the aim of fine-tuning is likely to come at a high cost, and it may be argued more as a matter of principles that the authorities should not be that intrusive. Now I'll turn to the Norwegian experience. This chart shows house price inflation in Norway and Oslo and the points in time when the BBMs have been implemented, tightened, or relaxed. In Norway, as in many other countries, BBMs have typically been implemented and tightened when house prices and household debt have increased rapidly. BBMs were first implemented in the form of guidelines by the FSA of Norway in 2010. It included an LTV ratio limit, which was tightened in 2012. An analysis performed by Norges Bank of the LTV requirement finds that the restriction has had an effect. That is, changes in the LTV limit shift the distribution of the LTV of new loans. In this way, the tighter LTV limits have contributed to lowering household sector vulnerabilities. In June 2015, the guidelines were formalized as a regulation, including a flexibility quota. The regulation was tightened in 2017, and the most important tightening involved the introduction of a new DTI measure, or debt-to-income measure, ratio limit of 5, a lowering of the LTV ratio limit for secondary home purchases in Oslo to 60% compared with a general limit of 85%, and a lower flexibility quota for mortgage lending in Oslo, 8% compared with 10% elsewhere. Hence, the 2017 tightening includes 2 regional elements affecting Oslo, one purely geographical, that is the flexibility quota, and one that targets a specific group of buyers, the secondary home buyers, who are arguably most prevalent in Oslo. The 2017 tightening seems to have had an impact, particularly on developments in house prices in Oslo, as you see from the blue curve in the figure. We believe that the combination of the new DTI requirement and the fact that the flexibility quota had to be complied with locally in Oslo, and not only at the aggregate level, were the 2 new measures that had most effect in Oslo. However, the extra LTV requirement for secondary homes in Oslo probably also had an effect. In this respect, Norges Bank has argued that the stricter requirements for secondary home mortgages could reduce the risk of investors selling secondary homes in downturns and thus amplifying a fall in prices. We therefore think that this restriction could help smooth the house price and credit cycle. This requirement has likely reduced buy-to-let purchases in Oslo and may have dampened price pressures. This may suggest that the requirement should also apply in other areas that may be attractive to investors in the secondary home market, for example, in the area surrounding Oslo. In areas where housing market pressures are more subdued, the introduction of the requirement will likely have modest consequences, and making the requirement apply for all of Norway and not only in Oslo could arguably make the regulation less complex and less ambitious with regard to fine-tuning. An econometric analysis of the DTI limit introduced in 2017 finds a significant negative effect on house price inflation in areas where we expected this restriction to be more binding. That is, areas of home buyers with a high DTI prior to the introduction of DTI requirement. The negative effect that was found lasts for about 1.5 years, and since we do not find a significant positive effect in the following period, the negative price effect is not reversed. The analysis also finds evidence for a negative effect on credit growth, although the effect is less clear-cut. Still, our takeaway is that BBMs are likely to have a cyclical effect on house price inflation and credit growth. In 2020, the mortgage lending regulation was temporarily relaxed. I'll come back to this episode. This chart provides us with information on the more structural effects on the different BBMs. It shows the share of new loans exceeding different requirements over time and enables us to follow the development in household sector vulnerability more closely. Since our regulation comes with the flexibility quota, these shares will in general be positive. In addition to the LTV and the DTI requirements, important borrower-based measures in Norway are a debt servicing capacity requirement and a principal payment requirement. The debt servicing capacity requirement states that the borrower should be capable of servicing the loan and still be able to afford a standard consumption basket, even if the interest rate is raised. The main takeaway from this chart is that borrower-based measures reduce lending to vulnerable households and thereby limit household sector vulnerabilities. This chart shows how new residential mortgage loans are distributed in the DTI LTV diagram. There we see a clustering of loans close to the regulatory boundaries, that is an LTV of 85% and a DTI of 500%. The red dots in the figure represent loans to first-time buyers. These buyers are in general closer to the regulatory limits. If we follow how this distribution evolves over time, which is not shown in the chart, we find that the clustering of loans moves towards the two boundaries from below. LTV and DTI are complementary requirements and have a geographical dimension. In rural areas with lower house prices, the LTV is relatively more binding and DTI relatively less binding, and vice versa in urban areas. This chart also gives support to our assessment that the regulation is binding. In the second and third quarter of last year, the flexibility quotas were temporarily increased to 20% both inside and outside Oslo. A motivation for this increase that came after the outbreak of the COVID-19 pandemic and the subsequent lockdown of society was a fear that the denominator in the flexibility quota calculation would fall if credit demand and supply were cut back. That could in itself result in a credit crunch for those who, during the pandemic, were in need of a mortgage exceeding the BBM requirements, for example, self-employed persons with temporary loss in income. Banks responded to the relaxation by increasing their lending outside the requirements. As the quotas were reduced to their previous lower levels, the share of loans outside the requirements fell back. In general, banks report that they normally prioritize young first-time homebuyers when they use their flexibility quota. The same was true in 2020, and data collected by the Norwegian FSA show that 68% of the loans outside the requirements were granted to young borrowers under the age of 35. Come to our final remark and conclusion, and I would like to start by saying that I'm quite optimistic about the role and usefulness of borrower-based measures. However, the effects and consequences of these measures are, to a large degree, still uncharted territory. There is a lot of analysis and research that has been made, but we still need to gain experience, develop our analytical framework, and understand better how different borrower-based measures work, particularly together, understand the interaction between borrower-based measures and other policies, both monetary, other macroprudential measures, and fiscal policies, understand which measures that are complements or substitutes and under which circumstances, and also understand better the cost of BBMs. Given our still limited understanding and analytical framework, we should not restrict the application and calibration of BBMs ex ante to be merely cyclical or structural. Our experience shows that borrower-based measures have both structural and cyclical effects. They can therefore be used both in a structural and cyclical way. And even fixed or structural requirements are likely to have cyclical effects. This comes from the cyclicality in the degree to which they are binding. This will generate cyclical effects of the regulation. Norges Bank has argued in favor of a simple rather than a complex regulation with regard to where and whom to target. Nevertheless, we have seen examples that the general requirements actually do a good job in being more effective in the regions and groups that are of concern. There may be situations where there is a need for targeting specific geographical areas or groups of borrowers for more cyclical reasons. The regulations should be transparent, and Norges Bank has argued in favor of a regulation with fixed or quasi-fixed restrictions in combination with adjustable flexibility quotas. The requirements may be changed if needed, but we argue against changing them frequently. Adjusting the flexibility quotas has proven to be as simple both for the macroprudential authority and for banks. Changing the requirements as a whole may be more challenging. So again, thanks for your attention, and thanks for this opportunity to share with you Norges Bank's views on and experience with borrower-based measures. Thank you.
Mr. Hegeland, thank you very much for a very interesting presentation. Just to remind our viewers that this was the third and the last presentation on this panel. But before opening the floor for discussion, I would like to remind all the viewers that you are able to ask questions in the comment box that can be found on below the video translation of this conference on the website of the Bank of Lithuania, which is www.lb.lt. And in particular, if you like a question that has already been asked by another viewer, you can press the like button, and that question will appear up front. I would now like to invite the moderator of this panel, Ms. Sandra Freeman-Clausen, who is a senior advisor for financial stability at the Swedish Financial Supervision Authority. Ms. Freeman-Clausen previously worked at the Ministry of Finance as a deputy director in the department responsible for the insurance and occupational pensions regulation. And prior to that, Ms. Freeman-Clausen was also a minister councillor of the Swedish delegation at the OECD. Mrs. Freeman-Clausen, my great pleasure. The floor is yours.
Thank you very much for the presentation, and we will dive directly into the questions. There's been a lot of questions in the chat function. I think we have a little bit of short of time, so I don't think we can we won't be able to run through all of them, but at least we will have time for a few of the questions posted in the chat. And I will start with one question, mainly to perhaps Torbjörn and Erlend, on that runs like this, and that is, what could be the main reasons why the borrower-based measures should not be changed too often in an upturn or financial cycle or loosen in a downturn? Would changing particular aspects of the measure be a solution if an authority still needs to take a measure? So perhaps Torbjörn can start on that one.
Yeah, I can start as I just said. We believe that the borrower-based measures should be viewed as structural and basically be not changed not changed too often. And if they are calibrated well and cover all sort of relevant cover the relevant margins of household sector vulnerability, they also and in effect are binding. They will also have a cyclical effect to the extent that the degree that they are binding vary across the cycle. But by adjusting the flexibility quota, one could also have an additional cyclical adjustment. In terms of the regulation to be viewed as changing the regulation too often may sort of undermine the support for the regulation, may be viewed as unfair across the cycle, and also reduce the chance of having it over the cycle. So our main view is that, well, it should be viewed as structural, but it has cyclical effects. Thanks.
Perhaps I could pass over to Erlen and add on a bit on that question. If you could touch on the sort of political economy of changes. We've seen comments, some stating that there is a certain inertia in these changes, others saying that there is a pressure on politicians to act. So how do you see the balance between these two types of arguments?
Yeah, I mean, I think it's the pressures may be a little bit different in upturns and in downturns. I think that, and it also can go both ways. But my sense is that if asset prices are rising and they are already high, it can be quite difficult for the authorities to throw another obstacle basically into the way of borrowers to finally purchase their home, right? So it can be tough to bring in additional constraints if asset prices are high and rising, unless the authority can sort of spin what they're doing to say, hey, actually what we're doing is to somehow tame what are crazy house price developments, and that can be popular. But then, I mean, that kind of requires the authorities to pretend to want to do something about prices when actually that's not the objective, right? The objective, as we've all said, I think, is to reduce the buildup of vulnerabilities that come from increases in debt ultimately, rather than increases in prices. And so, yeah, so I think in the upswing, sometimes it can be tough for authorities to bring in new measures. And that's why I think the experience of those countries that have acted early and have brought in, let's say, a loan-to-income ratio requirement at a time when house prices were not bubbling over already, is a useful example. So I like the the Irish case where they brought in this LTI requirement really early. House prices in Dublin were still sort of coming down, from the GFC peaks, essentially still a trough in prices, just about a recovery, I suppose, in prices in Ireland. And they took, their package of measures in that environment. And I think they were successful in bringing in fairly tough LTI requirements, actually, at the time when people were focusing perhaps more on the LTV, and when all of these ratios were fairly easily met by households. So that was, I think, useful for them to pass these measures in an environment where they didn't face all that much public backlash. So that's the point I was trying to make, I think, at the end of my presentation, and hopefully it's a little clearer now. So I think that could be useful to act early, to bring in essentially these automatic stabilizers early on, and that then essentially also reduces the need to respond to sort of cyclical requirements, because the LTI has cyclical or counter-cyclical effects, even if you don't vary it all that much.
Okay, thanks. I'll follow up with a question to Marek as well. I touched on that earlier, that there had been no pressure for changes in Slovakia. But I wonder how you see that in relation to the actual thresholds that originally were set for your measures. Do you think that this has corresponds a bit to sort of how tight the measures were? That's a question for Mark.
Sandra, I'm sorry for this technical problem again. It seems that all these technical issues have been accumulating to me today. Well, so you ask about our thresholds and how we set thresholds in Slovakia. Is this correct?
Yes, so, and how tight they were going into this, because you have mentioned in your presentation that there was no discussion about changing the thresholds.
Well, there was a discussion. There was no, let's say, public discussion or public, let's say, tough discussion with the banks. So officially banks were, let's say, okay, not satisfied that they were not against our measure. So that was this official public view. But of course, internally, when we discuss these topics with banks, so usually those discussions are very difficult. But here, maybe to mention three things that were quite important. So we tightened 4 times. And we figure out that probably the best way how to start with tightening is to start at current market practices, because we simply don't want to make a shock to the market, not just to banks, but also to clients. So they need probably certain time to adjust to this new situation. So that's the most important factor. And maybe that was also the reason why banks were not so tough against our measures. And second thing that is also very important, we try to be very transparent to the banking sector. So all the time we see some growing risk or there is something we don't like, we try to very openly communicate. So we try to make our policy foreseeable. So again, no lightning from the blue sky. So banks are usually aware, okay, that something's happening, central bank may come with some of the new tools. And maybe third thing that is also very important when we speak about reaction of banks, I mentioned that usually those discussions are quite difficult, quite tough. And you have to be very well prepared for the discussion, and you need to provide very good arguments. So you need very good analysis, good data. Here, let me stress what we found is very useful is to have a loan tapes, because that gives you really in-depth information of the situation in the market, and you can really discuss with the banks as an equal partner, because you have all this information that banks have. So if you put all these three things together, so maybe that was the reason why there was not really tough public reaction from the banking sector.
Okay, thank you. From the audience, we have one question that is the most popular for the moment, and that is, do you see a space for application of the Borrowerbased measures, increasing the resilience of non-financial corporations? And perhaps Erlen wants to start on that.
Yeah, I think maybe that's the topic for the next conference, because it's a big topic. Yeah, I mean, I think we've thought about this a little bit at the IMF. We think that borrower-based measures are less easily applied to corporate borrowers than to households. In part because there's so much heterogeneity across firms that you don't really have or can't, well, that is difficult to capture with very simple ratios, and so the sort of the complexity of getting these kinds of constraints right for everyone across different sectors of the economy, of the manufacturing versus utilities and so on, is going to be high. Yeah, so that's students of corporate finance will know, for instance, that you know, debt capacity varies across firms. It depends on the volatility or not of the income stream that corporate firms can expect. And so, yeah, we think it's harder to try and come up with good designs that work for corporates as a whole. It may be more possible to put constraints around borrowing in particular sectors, and we think that commercial real estate is an example of that, where again the you know, the business model or the practice is you know, there's not so much heterogeneity once you focus in on that sector, and it's possible then to think about constraints that kind of work for the sector as a whole. Perhaps with exceptions and so on, as we have them also for the household measures. So overall, likely to be possible, but harder than for the households.
Perhaps Torbjörn wants to add on.
No, I think just share Aaron's reflections on this matter. And he sort of spelled out both the possibilities, but also the challenges of using borrower-based measures for corporates. Thanks.
Marek, do you want to add something?
No, not really. I fully agree with Erland that it's quite complicated. It can be useful, and we also see growing indebtedness of the corporate sector, but having in mind this huge heterogeneity of the corporate sector, it's quite challenging task.
Okay, then I'll move on to a question to Torbjörn regarding this interesting plot chart that you showed us, and on the quotas. And I wonder about the what are the households that actually are in the quota part, and the non-quota. Are you seeing any sort of risks connected with the households that actually do get the quota? And I know that at Norges Bank also have very interesting data on the asset side of households. So is there any cross-references to that data that is interesting in relation to the household, how the households are split?
Yeah, I mean the data supporting the plot graph that I show in the presentation are based on a survey by the Norwegian FSA that covers actually all new mortgages over a period of time each fall, and they do it annually. Both this data source and other data sources that we have available show that banks tend to prioritize young home buyers when they use the flex quota. So from a generational distribution perspective, we think that this is positive, that at least some young household, first-time buyer households, where that may have a lower risk than the standardized than what is captured by the standard measures in the BBMs, couples that have good income prospects as such. It has been a concern that first-time home buyers are particularly hit by the borrower-based measures. Data show little signs supporting this concern. There is no actual change in the propensity of younger households to buy homes by the first home after the introduction of the DTI quota. This may be due to parental support, which then of course means that young people with parents that are relatively rich may be the winners in the housing markets at the cost of those with younger people with poor parents. But of course, even if young borrowers have less income than older, and therefore they may end up with relatively high DTI, their expected income growth is higher. If we use balance sheet data for the whole population of households and follow the development in the share of household with high DTI, high LTV, and limited liquidity, and showing that household may end up with a high DTI due to a fall in income rather than an increase in debt. Households may also reduce their income voluntarily by reducing hours worked, etc., and experience unemployment. And we plan to update our analysis of all harm buyers. We take advantage of detailed balance sheet data next year. So this is something that we do explore, but we think that what the banks use the flex quota for in general, they use it in a sort of a sensible way, not sort of undermining the purpose of the regulation, but rather to smooth some of the possible negative effects from standardized requirements. Thanks.
Okay, we have some more questions in from the audience, but unfortunately, I think we have to close this session at this stage and to hand over to the next session that is due to start shortly. So thank you very much for your very interesting responses to the questions.
Thank you.
Thank you very much to the moderator and the panelists for a very interesting discussion. I would like to invite everyone to the second panel of today. And the second session will be focusing on the country experiences with housing market fluctuations during the pandemic. The presentations that will be given by the presenters will address the role of the borrower-based macroprudential measures in these events. Before starting the panel, I would like to once again remind the viewers of this conference that they're able to ask questions in the question box that is below this video translation online. And if you like a question that has already been asked by another viewer, you can also press like button, and that will push the question up front. I would now like to invite Mr. Libor Holub to open this panel. Mr. Holub joined the Czech National Bank in 2014, where he initially worked in the Financial Market Supervision Department. He then became the head of the Macroprudential Policy Division and the Deputy Executive Director of the Financial Stability. So, Mr. Holub, please, the floor is yours.
Good afternoon. Thanks to organizers that we can share our experiences from Czech Republic related to borrower-based measures. My presentation consists of 4 parts. We look at how successful were borrower-based measures in ensuring resilience. What are the general lessons drawn from use up to now? What are the reasons for relaxation? Because we belong to the authorities which relax BBN at the onset of pandemic, and some remark regarding adjustment or recalibration of borrower-based measures. In first part, we will look at the cycle housing credit and housing prices development in Czech Republic. What was the policy design, and what was at the end final resilience of borrowers, and we will look also on household credit portfolio performance during the crisis last year. So at the beginning, regarding the cycle, financial cycle indicator still trending up despite a substantial drop in GDP. In Czech Republic, the growth phase started in 2015, and the housing is a substantial component of this financial cycle. During the COVID crisis, the economy dropped down substantially, as you can see in the right-hand graph chart, but now is trending again back. Regarding the Czech economy is strongly oriented on industrial production, and therefore the impact in services was very important, but not so critical for the overall economy. Regarding housing credits, comparatively low overall household indebtedness grew relatively slowly during the cycle. So you can see the indebtedness increased from 50 to 60% of GDI, which is in comparison with Europe and world a relatively low level. What we can see during the period 2015 to 20, this is strong growth of housing loans. There was some period of cooling down, as you can see in 2017 and 18, but still currently the growth is quite strong. Regarding housing prices, residential property prices grew from 2015, and there are no signs of change in 2020. And even in 2021, we can see no change. The prices are still growing. We are considering overvaluation in our policy, and overvaluation of apartment prices level is now estimated in a range between 15 to 25%. Our policy design during the past years was centered around LTVs and DTI, DSTI as in other countries. We started with level of LTV 85% in 2016, and as the overvaluations grows during the time, then we reacted and tightened the limit of LTV to levels 80%. With some speed limits. DTI and DSTI level were introduced firstly in 2018, and the level was 9 and 45. And in 2020, at the beginning of the crisis, we eased standards to LTV 90 and DSTI in first round 50, but finally it was abolished. Currently, we are running only with LTV in place, and the DTI, DSTI were abolished. There are some speed limits which are currently as 5% of new loans which can be provided with LTV, DTI, DSTI higher than the limit. This easing in 2021 was based also on the behavior of the banking sector. When we see in the second quarter and also in third quarter relatively prudent behavior of the bank, which on their own make some more stringent credit standards and credit conditions, which we see are eased only in the past quarters. We are aware about the potential problems of borrowers, and we did some analysis which were published in our financial stability report, and there shows that resilience of borrowers improved markedly during the time, especially after the introduction of borrower-based measures. Estimated mortgage loans default in adverse scenario remained rather low, and besides wage growth, the important role plays also income indicators which were introduced. We also try to evaluate what is the resilience to adverse events, and some sensitivity analysis of potential impact of rising unemployment and increase of interest rates does not indicate substantial increase of mortgage loan default rates. You can see in the graphs that increase is relatively mild and definitely not systemically important. Regarding household loan portfolio performance in last year and for first half of this year, we can see that pandemic induced some risk rebalancing in the left chart. There is a visible increase of stage 2 and 3 loans by roughly 10 percentage points. But the end of moratorium in October last year didn't lead to any significant impact on the portfolio. Mortgage loan losses in last year were negligible. This year are even lower. and the whole banking sector remained profitable in all lines of their business. So it is the situation we were in last year when the crisis hit us, and you could see a development afterwards, in short. And now I will tell you more about lessons which we draw with usage of BBM so far. Our approach was that the resilience of banks and households is main objective. What we can see is that we should do it timely, but from a point of view of effectiveness on credit growth and real estate prices, we see that there are some substantial constraints. And I will cover also general public awareness issues. So regarding the resilience of banks, our policy was pursued as recommendation towards any provider of mortgage loans. So it was activity-based, not only for banks. Basically, it was preemptive in nature with comply or explained principles. And we try to help to define prudent lending procedures and standards. And the goal was to enhance existing internal risk management systems of institutions and encouraging a prudent approach to lending. This prudent approach to lending finally has positive effects on the extent of the household mortgage loan risks. This collateral resilience is visible on the data we have available. You can see changes in mortgage portfolio structure by year and LTVs. On left chart, you can see the collateral value at the initiation of the contract. And you can see that after LTV limits were introduced, then the share of loans with LTV below 80 went up substantially. And let's say more risky categories were lower. If we look at last revaluation collateral value, then the situation looks even, let's say, more positive from risk point of view, and loans below LTV 80 are now at the level 86%, and from general point of view, the most of loans should be, let's say, safe, even if the overvaluation will be really in this extent we are considering. Regarding debt service resilience of the household, we did see some negative development of portfolio structures by LTI and LSTI during 2016 and 18, but it was brought to halt also by introduction DTI and DSTI indicators in 2018. Improvement indicated by LSTI mortgage portfolio structure was not fully matched by LTI, as you can see on the if you compare both graphs. But because high loan amounts and some LSTI features works in favor of fulfillment of LSTI. Regarding timely activation, we activated LTV at the moment when prices started to depart from estimated equilibrium levels in 2016, and new mortgage loan production during years 16 and 20 should be shielded from the risk of substantial price correction, which could bring collateral value below due loan amounts. A positive impact has also regular repayment schedule, where the mortgages in Czech Republic are regularly paid. The level of repayment is between 2 to 5%. It depends on the maturity of the loans, remaining maturity of the loan. DSTI and DTI was activated later in this cycle. And it was when the mortgage growth shows historical heights in 2017. And new mortgage loan production during years 18 to 20 should be lower risk with regard to potential rise in unemployment and interest rate, as was shown in the slides before regarding resilience of borrowers. Positive impact regarding interest repricing risk has prevailing fixation period 5 years or longer. Currently, it's about 8 years. And again, the regular repayment schedule. Policy measure had very limited impact on credit growth and residential real estate prices due to subdued activity in housing construction. You can see on the left chart, there is some increase in starts and completion, but definitely it's not in quantities which could make some difference in the development. And apartment affordability indicators shows further deterioration in our case. Very important for us was also public awareness and financial education. This CMB recommendation was firstly issued in 2015. It has legal and non-binding character and didn't hamper its efficiency, whereas banking sector adheres to recommendation, sometimes with delay, and they are main providers of mortgages in Czech Republic. LTV, DSTI, and DTI introduction was followed by extensive CMB communication, helping to build up general awareness of the risks, and presence of measures positively impacted financial education. This potential risk of circumvention or arbitrage because of non-binding character was finally mitigated by the extension of the CMB legal powers to set loan indicators LTV, DSTI, and DTI in 2021. Some remarks regarding reasons for relaxations. It was mentioned already by the speakers that there are cyclical or structural issues in those risk measures. What we see that the level of household indebtedness is not structurally high in EU comparison, and prevailing motivation to avoid cyclical build-up of systemic risk in mortgage portfolio drive our decisions. Then we have to consider a relationship to other macroprudential instruments. Our mortgage portfolio is resilient due to timely BBM activation, existing capital buffer levels, including released CCIV, and restriction of distribution of profit. What we see at the beginning of the crisis is that the risk-taking appetite of the banks is changed. On the eve of the pandemic, bank tightened lending standards under expectation of adverse development. Macroprudential policy involvement we perceived like less needed. And from, let's say, more general point of view, even it's about our role in the situation. We believe that when the particular systemic risk is predominantly cyclical component, then high probability of the change of the phase of the cycle allow easing of measures. And market under stress works on its own prudently. And in such situations, quick and decisive action based on thorough consideration expected. About effectiveness, there are the question how to measure this effectiveness. If we consider loans growth, that we can say that after a short period of contraction in 2020, it returns to pre-crisis growth level. And motives of borrowers partly differ from pre-crisis period. Inflation consideration bundled with expectation of monetary policy tightening in season could create front-loading effects. And fiscal loosening via decrease of income taxes, cancelling residential real estate purchase tax, and income support measures brought additional incentives for buyers. Increased demand for investment is perceived as safe haven also plays very important role. If we look at effectiveness from perspective of fulfillment of our recommended limits, then we show that LTV shows relatively minor relaxation, and it may be interpreted as cautious approach of the banks to valuation of collateral. Definitely question is if it will last. If we look at the DTI and DSTI, and we measure it by using the space created by relaxation, which could be maybe perceived like risky, but from certain perspective, it could be, let's say, return to practices before measures introduced. So DTI, DSTI returned to and crossed pre-BBIM levels and allowed more intensive credit growth. Main factor of the development are higher real estate prices, resulting in high average loan amount, which was doubling from 2015. CNB communicated to banks last year and this year as well that further loosening is deemed risky. We will look if relaxation continue and overall banking sector behavior will be important for the future policy considerations. Decision about next steps should be taken in December this year. Now about necessity, we can discuss what is the role of macroprudential policy in crisis episodes. If we reacted predominantly to cyclical risk, there is the trade-off between quick and decisive action in the time of crisis to ease credit condition versus risk of further build-up of risk if crisis is relatively short and averted by massive state intervention. This is the situation which happened, but this we can see just now. It was not such clear last year in first half of this year when the crisis started and nobody was able to tell what will be the future development. We can maybe look for some parallels when released CCYB at the beginning of pandemic was quite immediate action of macroprudential authorities. So in ability to support the economy and let's say provide more loosened conditions, it seems reasonable. And some final remarks regarding adjustment, recalibration, and low interest rate. This cyclical development will be an important factor in potential adjustment. The intensity of the loan growth and impact of distribution of LTV, DSTA, and DTA of the new loans will be considered probably, and impact of other active macroprudential measures on particular systemic risk will be taken into account. There is in our case also an important factor, which is monetary policy. This tightening started. We have now the monetary policy rate 1.5%, and it may cool down mortgage loan growth. Recalibration, this LTV limit levels will potentially react on estimated levels of violation, and DSTA, DTI limit levels and indicators choice will be instructed by expected interest rate development and reasonable maturity profile, because in the case of DSTI, there is a visible trend to increase maturity of the loans, and it can ease the DSTI limit. Regarding low interest rate environment, this is not our case now, but definitely DTI, DSTI calibration have to take into account risk of sharp rise of interest rates. If interest rates are low at the time of activation, and it should improve debt services capacity of household in the future. Thanks for attention, and it was a pleasure to provide you with some experiences of Czech Republic in this area.
Mr. Holub, thank you very much for the rich presentation. Let me now turn to the second panelist, who is calling us from a very, very far away from New Zealand, Mr. Duncan Mills, who is the lead advisor on macroprudential policy in the Reserve Bank of New Zealand. Mr. Mills has a background in economic regulation and competition, and prior to joining the Reserve Bank of New Zealand, has extensively worked in the energy sector, both in the UK and in New Zealand. Mr. Mills, I'm very well aware that it's well past midnight already, so thank you very much for being here today with us. Mr. Mills, please, the floor is yours.
Hi everyone, and thank you very much for that introduction. Just to confirm, the time at the moment is 1:20 a.m. to be exact, so it would be much nicer to be in Vilnius right now, but I do appreciate the opportunity, and it's been really good to see all the presentations so far. Today I'll be talking obviously about New Zealand's experience during COVID-19 with borrower-based macroprudential tools. Just briefly, I will start off by discussing some general features of New Zealand's housing market. Then I'll explain what the macroprudential framework is in New Zealand and how we have used LVR or LTV restrictions, which are really the only borrower-based tool that we have used to date. Talk a bit about the COVID response and the outcomes from that, and then briefly lessons learned and conclusions at the end. So New Zealand's housing market has the dubious distinction of being one of the fastest growing, I believe, in the OECD since around 2000, as you can see in the left-hand chart. Real house prices were already running well above a number of other OECD countries, and then, as you can see, they've ticked up even further since the COVID pandemic and the response to that. There's various reasons for that, but not surprisingly, a key one is underlying supply-demand imbalances and sluggish supply response combined with high rates of immigration. And that's particularly been an issue from around 2013 up until recently, as you can see in the right-hand chart. That is starting to come back into balance now because supply has been ramping up rapidly, and obviously with the borders being closed, immigration has dropped to virtually zero. So we are expecting that to come into balance over the next couple of years. Household debt levels are high, and after a few years of relatively stable debt levels, they've ticked up again. Another feature of the New Zealand housing market is that people tend to fix for very short terms compared to a lot of other countries. So in the chart on the right, you can see the bulk of almost all mortgage holders are fixed for periods of 3 years or less. There's a really big chunk that are on 1 year fixed, and only a very small proportion on fixed of more than 3 years. Obviously, that makes these borrowers quite vulnerable to repricing. Fixing for short terms has been a great strategy over the last probably quite a long time now, but that may no longer be the case for much longer. As far as the macroprudential framework in New Zealand, the Reserve Bank Act, we act as both monetary and financial stability agency. There's no separate prudential regulator. We have a memorandum of understanding with the Minister of Finance that sets out the range of macroprudential tools that we may use, and within those are the standard sort of capital liquidity tools and borrower-based tools being loan-to-value restrictions, recently, we have had debt serviceability restrictions added to the MOU, but those have not yet been implemented. That's something we'll be looking at later in the year. We also recently had a government direction on housing policy, which has added another strand to our objectives, which has asked us to have regard to supporting more sustainable house prices, and that includes by dampening investor demand for existing housing stock in order to help first home buyers. The LVR restrictions have been in place since 2013. Key objectives, they have shifted a bit over time, but I think obviously the main ones are strengthening bank and borrower balance sheets, leaning against the credit cycle, reducing the likelihood of negative feedback loops occurring in a correction. And then more recently, we have these additional objectives of keeping house prices sustainable, which we're still figuring out exactly what that means, and then potentially dampening demand for investment property. We already had some reasons for doing that from a financial stability basis, given some evidence from overseas that investors are more likely to sell up in a severe downturn, although we haven't actually witnessed that in New Zealand, partly because we haven't had a severe downturn. Actually, investors have lower non-performing loan rates than owner-occupiers. But nevertheless, there is that concern that that might not be the case if there was a serious correction. And then on top of that, there's the government policy, which is pushing us in the direction of focusing more on investors. The LVR design is similar, I believe, to most other countries. There is a speed limit and a threshold. It applies to the flow of new loans by value. We do have different limits between owner-occupiers and investors, and there are exemptions in place. The main ones at the moment are for new build properties, and also for some first-home buyers, the ones that are eligible for government support, they are exempted from LVR. So on the table on the right shows how the settings have changed over time. I won't go through that line by line, obviously. But overall, since the settings were brought in 2013, they were then tightened up until around 2018. We did have a brief phase of having separate limits on Auckland, but that led to quite significant spillovers to the rest of New Zealand. So that was then collapsed back into a nationwide settings, but differentiated between investors and owner-occupiers. The settings had begun to be loosened from January 2018 onwards, and then when COVID hit, the restrictions were removed entirely. I'll get on to what that led to later on. Looking at the pre-COVID picture and what we saw with the experience with the LVR restrictions, you can see that when the LVRs were imposed, and then particularly when they were tightened on investors, we did see a fall in lending to investors overall, and particularly lending to investors at high LVRs. And in the loosening phase, that started to unwind a little bit. Over time, the LVRs have quite significantly improved the picture with the loan stock. The total share of the loan book at high LVRs has come down quite a lot. And then in terms of the impacts on house price inflation and credit growth, obviously it's always difficult to disentangle cause and effect, but there does seem to be some relationship, particularly when the investor limits came on and then were tightened and made nationwide, with the subsequent fall in house prices and credit growth. Moving on to the response to COVID. Obviously, the key focus of this presentation is on the borrower-based tools. So as I mentioned previously, the restrictions on high LVR lending were completely removed in April 2020. And there were two key reasons for that. There was obviously the general the general view that credit conditions were likely to tighten significantly and that we should be looking to remove any potential barriers to that, to act in a counter-cyclical way. Another one that was actually quite important at the time was that there was a view that the LVR restrictions might present a barrier to the mortgage deferral scheme that was being set up, basically because as banks deferred principal payments, that could push up LVR ratios, and banks were worried that might put them in breach of some of the regulations. In retrospect, I think that perhaps wasn't such a concern, and it could have been worked around in another way. But at the time, obviously, decisions were made under time pressure, and that was seen to be the easiest way to address that concern. Like other countries, we obviously had significant monetary loosening, also very large degree of fiscal support from the government. And subsequently, as you'll see in the next couple of slides, the economy recovered very quickly. Housing market, after a very brief dip, started to come back very strongly. And ultimately, that led us to reinstate the LVR restrictions in March 21. So basically, they had been off for a bit less than a year. And since then, we've tightened them twice further. We tightened them on investors in May, and we're just about to tighten them on owner-occupiers starting from November. Just as far as, I won't go into much detail, but obviously New Zealand, as you probably know, has been one of the lucky ones with respect to COVID. As you can see on the left, we've had very low case numbers compared to other countries, and the health response has been very effective. We are in the middle of an outbreak at the moment, which they are trying to contain. So we'll see where that goes. Delta obviously is more challenging than previously. But as you can see on the right, you know, GDP, it did obviously dip when the lockdown started, but we are actually already back to slightly higher than we were pre-COVID, and I think that's true for unemployment now as well, or we're certainly very close to pre-COVID levels. Total mortgage lending, again, brief dip that you can see just in early 2020. You see some seasonal variation as well, but then it's risen to all-time highs for all types of borrowers. And we also saw significant rise in high LVR lending flows, particularly to investors, as you can see in this chart. So we've got investors with LVR over 70%. That bumped up quite a lot when the restrictions were removed, and the overall share going to investors bumped up as well. There wasn't really much change in the owner-occupier share of high LVR lending. If anything, it seemed to go down a bit. I think that was probably more because the investor share went up by so much that the owner-occupier stayed stable or actually went down a bit. So back to the previous chart, but taking us through to the post-COVID period, you can see that the LVRs were removed, and very quickly the house price inflation rate shot up to, even by New Zealand standards, extremely high levels. We're now running at about 30% annualized. There hasn't been much sign of a slowdown yet, and the momentum has sort of continued to surprise everyone. Since the LVRs were reinstated, no obvious impact on house prices. There has been a bit of a slowdown in credit growth, but you know, again, cause and effect. Not necessarily trying to imply that this was, you know, a causal relationship, was certainly the only factor. Lending stocks change much more slowly, obviously, because you're looking at the total loan book. There was a slight tick up in LVR loan stocks when COVID hit, but that's now dropped back again, and it's certainly still well below the levels that it was when the LVRs were first imposed around 2013. So what are some of the conclusions and lessons learned from New Zealand's experience with borrower-based measures? So I guess firstly, we do see that they've had structural benefits in reducing housing market risk by significantly reducing the stock of high LVR loans. Some of that obviously is offset by lower capital requirements on high LVR loans, but nonetheless, we do see that as being structurally favorable to financial stability. And then reduced share of investor lending, both overall and at high LVRs, arguably also positive for financial stability and reducing housing market risk in case of a severe correction. We've also seen some evidence of short-term countercyclical impacts. We've done a few different bits of research that has found, some impact on house price inflation, at least in the short run. We've come up with figures ranging from 1% to 5%. Obviously, these are, small impacts and they're only short-term compared to the underlying fundamental drivers that have, seen our house prices rise so much as presented in the first part of the presentation. It seems as though the impact on house price inflation may have been stronger in the earlier phase of the restrictions, at least in terms of reducing house price inflation. I think that's probably because at that stage we were starting from a higher base of high LVR loans. So there was, the restrictions were biting more at the early stages when the restrictions first came in. So in terms of the experience during the pandemic, it's always hard to disentangle the relative factors, but it does seem as though loosening the LVR restrictions at the same time as loosening monetary and fiscal policy may have been a contributing factor to the post-COVID house price boom. I think monetary easing is clearly the main factor, with the LVR removal secondary. And the impacts may have been particularly strong in New Zealand due to the underlying drivers that I discussed earlier, supply-demand imbalance, relatively sluggish supply response, tax incentives to invest in property, various other issues. I think what we have seen, and we saw this clearly in the last year, but also if you look further back, I think you could see it too, that one of the main impacts of taking the LVR limits off together with the market rising is that one of the things that does is that it allows existing owners to leverage up more easily into additional property because they can borrow against the equity in the property that they already own. So you do get into a sort of pro-cyclical dynamic, even if you are using LVR limits and tightening them, because you are trying to kind of get ahead of the curve to some extent. And in a rising market, as equity levels go up, then the LVR limits, automatically tend to bite less on existing property owners, at least those ones that want to buy additional property. So that's leading us to think that longer-term debt serviceability tools might be a better option for a kind of steady state and type of tool, and that they are likely to be more effective for leaning into an upswing. A bit late for this one, but possibly next time around. We haven't seen any evidence that tightening LVR restrictions has impeded monetary and fiscal policy. If anything, could be argued that it's allowed the settings to stay looser for longer by, addressing some of the spillovers into housing market and financial sector risk. From here, in terms of what the Reserve Bank of New Zealand is doing on the macroprudential front, so with the recent tightening on owner-occupiers, our LVR settings are now going to be at their tightest level since they were first introduced. It's going to be the same as at the peak of the last boom, which was around 2016-17, peak of the last cycle, I should say. So further LVR tightening is probably unlikely at this stage, although we are going to be having a look at some of the sort of underlying framework and looking at the exemption regime to see if that's still fit for purpose, if there's areas where that needs to be tightened up. But as far as the actual thresholds and speed limits, they're probably not going to go any tighter from here. However, we will soon be launching a consultation on debt serviceability restrictions. We'll be looking at both DTI, LTI, and DSTI types of tools, most likely looking at implementation sometime in 2022, and hopefully that will be in time for the next cycle. That's everything that I had, and thank you very much for the opportunity to present.
Mr. Mills, thank you very much for sharing your country's experience. Let me now invite the third panelist, Mr. Thomas Sandgil, the head of Systemic Risk Analysis and Policy Division of Denmark's National Bank. Mr. Sandgil is responsible for the central bank's work on the macroprudential policy and stress testing. Mr. Sandgil is also head of the Secretariat of the Danish Systemic Risk Council. And prior to that, he has been working in the Capital Markets Division of the European Central Bank. Mr. Sandgil, please, the floor is yours.
Hello, everyone, and thank you very much for inviting me to this very, very interesting session. It's quite an honor to be here, although, of course, it would have been a bit different if we had seen each other physically. Okay, but let's get started. Just a very short introduction of what I'm going to say to talk about today. First, a short introduction to some structural features about Denmark and the Danish housing market, and then I will move on to the subject of this conference, the macroprudential stance before, during, and after COVID-19 in the case of Denmark. So let me start by highlighting the structural feature of the Danish housing market that all foreigners often tend to focus on, namely that the Danish households continuously rank among the most highly indebted in the world. I think it's important to note that this high gross debt is also matched by corresponding large assets such as real estate and pension schemes, but nevertheless, large amounts of debt make the Danish economy and the financial system more vulnerable to shock to the housing markets. So I think it's fair to say that a wise strategy for a macroprudential authority in a country like ours is to encourage banks and borrowers to be better safe than sorry. And just to already now give you a flavor of my conclusion, I think it's fair to say that we are not yet there, but I will get back to that. The Danish households were the most highly indebted in Europe 20 years ago, and we still are. Yet the introduction of the interest-only mortgages in 2003 really made credit growth soar. It took just under 5 years from the introduction of the loans with deferred amortization until they actually constituted more than half of all mortgage loans. I think this is equally fascinating and scary to look at. The result was a housing bubble that left Denmark with a financial crisis that was unnecessarily hard. If we look at what have happened more recently, we can see that the share of interest-only mortgages have gradually declined a bit, but actually they have started to go up a little bit here in the last year. Systemic risk related to the widespread use of interest-only mortgages are higher in a world with interest rates around zero. This would basically imply that the debt service levels becomes very, very small, allowing households to increase leverage quite a lot. if we move on and look a little bit at house prices, and I'm not going to dwell a lot on this, but during the pandemic, house prices in Denmark caught most economists by surprise, including at the central bank. So during the first lockdown, we had 2 months of initial price declines back in March last year. But these first responses were quickly followed by a soaring housing market with double-digit annual growth rates. I guess that too much time spent in a too small house or apartment has probably led to a preference shift towards larger housing units. At least we cannot explain the price increasing using our standard models. And as you can see this, and as you all know, this was also the case in our usual benchmark countries. Early evidence suggests that prices are likely to cool down now, yet I tend to think that it's too early to make a firm conclusion on where prices will move from here. As mentioned before, when you don't amortize and interest rates are close to zero, then the debt service to incomes will be very low by construction. And this chart displays what we call a stylized housing burden or debt service to income for 4 different mortgage types, a 30-year fixed rate versus a variable rate, and then for mortgages with amortization and mortgages without amortization. And what you can clearly see here is that what really matters is if you choose an interest-only mortgage or if you choose a mortgage with amortization. If you look at the one with amortization, you can see that this stylized housing burden is actually approaching a level comparable to what we saw before the financial crisis. Whereas if you look at the interest-only mortgages, we are at a much lower level. So should we stop worrying about the housing market because debt service to income ratios are low? Are we certain that existing measures are sufficient? I think our answer to this question is clearly no. The combination of very low interest rates and widespread use of interest-only mortgages is a structural problem. I mean, what is the fair price of a house is nominal interest rates remain at zero and households don't amortize. And you can add households own a negative interest rate on their deposit account. Let me now say a few words about the housing market-related macroprudential stance before, during, and after the pandemic. If we start before the pandemic, after the financial crisis and before the pandemic, Danish authorities have taken several measures to limit the riskiness of Danish mortgage lending. And I have listed some of them here. A bunch of empirical studies have shown that interest-only mortgages contributed to making the financial crisis in Denmark more severe than it otherwise would have been. Hence, quite a few of the measures aim at restricting the availability of interest-only mortgages. I think the bottom line here is that there was and there still are measures in place to address high loan-to-value ratios, high debt service to income ratios, variable rate lending, and interest-only mortgages. Yet we would like them to be a bit more binding, more restrictive. We think it remains too easy to get full access to interest-only mortgages at high LTVs and high debt service to incomes. This slide is just another way of showing the initiatives in the previous slide. It shows that the mortgage product supply is a function of both LTV and debt to income. And in the footnote, we have tried to also introduce the geographical dimension of our regulation. I won't go into details, just say that the rules today are fairly complex. While these measures have been introduced, we have had some discussions if they limit the access to mortgages for first-time buyers or elderly people. We have spent some time at the central bank looking into this, and so far we have not been able to find any evidence that this should be the case. For instance, the blue line shows the credit given to first-time buyers, and here we can see that this is actually steadily increasing despite these different measures being put in place. Also, we have looked if we could find any evidence that these measures have had any effect on the house price growth, and I will let it be up to you to conclude from this slide. But to me, I don't see any strong evidence that these measures have actually influenced house price growth. So summing up, before the outbreak of the pandemic, the borrower-based stance in Denmark was relatively loose, especially in terms of easy access to interest-only mortgages. This has been addressed by many policy recommendations from the Danish Central Bank since the introduction of interest-only mortgages in 2003. Also, we have had recommendation from the European Systemic Risk Board and from the IMF to tighten our borrower-based measures. And then we have actually had 2 recommendations on interest-only loans from the Danish Systemic Risk Council, and both of these were only partially followed by the government. And yet we had another recommendation in June this year, and I will discuss that in more detail. But before jumping onto our latest recommendation, I will say a few words about if macroprudential authorities should relax borrower-based measures during crisis. So here's a column of pros and a column of cons, and it seems that the cons contains substantially more characters than the pros. So the argument for a stop-and-go, tighten, release, and tighten again strategy would be that in theory, borrower-based measures could resemble the effects of the leaning against the Win fiscal and monetary policies, meaning that borrower-based measures could be used as a cyclical tool to either substitute or complement fiscal and monetary policy. On the other hand, looking at the cons, when making the case for implementing borrower-based measures, we make quite an effort stressing that the objective of borrower-based measures is structural, to enhance the structural resilience of households and banks' balance sheet. And if the objective is structural, I guess you shouldn't relax during a downturn to address cyclical issues. Also, I think the history has shown that it's actually quite difficult to implement borrower-based measures. So I think there's a risk that a temporary loosening could turn out to be a permanent loosening of the measures. And then again, the borrower-based stance would rather loose to begin with. So of course that also speaks in favor of not losing it even more during a crisis. And lastly, there's the consumer protection view. Do we as regulators want to advise homeowners or buyers or existing homeowners to choose a more risky mortgage in times of crisis? And do we want banks to grant these more risky mortgages? So looking at what actually happened, the discussion on whether to relax borrower-based measures were not that intense or serious. After all, the government put in place a lot of fiscal measures to counter the effect of the pandemic. And from the macroprudential side, we released the countercyclical capital buffer. And most importantly, house prices quickly started to increase quite a lot. And suddenly it was more an issue of tightening the borrower-based stance than loosening it. So I will now turn on to our recommendation to tighten the borrower-based stance. The Systemic Risk Council, which is chaired by the central bank, recommended to the government to prohibit the issuance of interest-only mortgages to households where LTV exceeds 60%. And as you can see from the chart, that's quite a lot of the mortgages that would be affected. 73% of new mortgage lending in 2020 had an LTV above 60%, and of this 44% was interest only. The stated objective of this recommendation was to increase borrowers' resilience, whereby also increasing the resilience of banks' balance sheets. The recommendation stated relatively clearly that house prices were not the main objective, although we did state that house prices would of course be affected because affected borrowers would get a higher debt service to income ratios, and therefore we would lower how aggressively they could bid up prices. We did not mention house price bubbles or overvalued house prices in this recommendation. And also, short note on the legal issue, we have actually implemented most borrower-based measures in Denmark as consumer protection, mainly because that was doable and easy. And this new recommendation would, however, most likely not fit into the consumer protection framework. The government would have 3 months to comply with this recommendation or explain why they would not comply, and the government simply said no. They did not want to tighten the borrower-based stance in the current situation. I know that you cannot read all these quotes in this slide unless you can read Danish, but I decided to include them as they show an important dimension when implementing borrower-based measures. The quotes here say that the council is shouting to the government to limit interest-only mortgages to avoid a housing bubble. And there's a quote from the Minister of Business and Financial Affairs, who is the one deciding on whether to comply or not, that state that it seems that housing prices are cooling off, and hence there's no reason to implement this measure. So despite the fact that the recommendation from the council was about resilience, then the public debate was entirely about prices. I guess that the soaring housing prices the past year were both a blessing and a curse for us. They definitely created a burning platform for us that we tried to use in order to fix some structural issues that we have been worried about for a long time. When the recommendation was issued, house prices increased quite a lot. On the other hand, house price growth and sale activity were cooling off somewhat during the summer, and hence all stakeholders that preferred a wait-and-see approach were arguing against complying with the recommendation with reference to a lower house price growth. So let me briefly go through some arguments put forward in the public debate for not tightening borrower-based measures. The first argument for not doing this is that the market will work it out. Our take on this line is that the housing market is currently heavily distorted. We have a rather high interest rate deductibility favoring high debt and those high house prices. Property taxation is not linked to market value, though it's not serving as an automatic stabilizer. And again, the high prevalence of interest-only mortgages in a zero interest rate environment. We also quite often hear the argument that debt service to income ratios remain low. Here I will say that's exactly why I'm quite worried that we have this very low interest rate environment with interest-only mortgages. A third argument goes that house prices may fall if we tighten the regulation, and then it's often added that we also feel sorry for first-time buyers. And here I would say that lower prices would be actually better for first-time buyers. And then also our calculation shows that the recommendation from the Risk Council would only have a rather small price effect. And lastly, some argues that debts have not increased a lot. And here I will say it has yet not increased a lot, and it has not increased a lot on average. A little bit more words on the increase of house price debt. there's typically some delay from house prices to higher household indebtedness. While house buyers increase their indebtedness in line with rising prices, it takes longer for homeowners to borrow against higher housing values. So, summing up, what are the general lessons from the last 10 years of borrower-based measures? The target of borrower-based measures is to increase the structural resilience of households and banks' balance sheet. Yet I think we must admit that we haven't been very successful in explaining that need to the public. We have also learned that borrower-based measures are difficult to implement. The legal basis for borrower-based measures is only partially there. We have had to use consumer protection legislation, and I think it should be an important part of the Commission's macroprudential review to add tools. So to sum everything up I have said today, I think that in the case of Denmark, when it comes to the housing market at least, COVID-19 will go into the history as a missed opportunity to do the right thing, because at least for the Danish housing market, it's never the right thing, the right time to do the right thing. And on this rather pessimistic line, I will end my presentation. Thank you for listening.
Mr. Sanger, thank you very much for your interesting presentation. Before opening the panel discussion, I would like to remind the viewers that you are able to ask questions in the comment box that is just below that translation. And I would also like to let you know that we very much value your opinion. Therefore, you're very much kindly asked to provide us with your opinion about this conference, about the speakers and everything else. So you can do this in the little icon that can be found just above the chat function in the below the video translation. Without further ado, I would like to introduce the moderator of the last panel for today, Mr. Tuomas Peltonen, who is the Deputy Head of the Secretariat of the European Systemic Risk Board. Tuomas, for many years, has been working at the European Central Bank and also holds a PhD in economics at the European University Institute. Dear Tuomas, it's my great pleasure to invite you to take the floor, please.
Good afternoon.
Good afternoon.
Good afternoon.
It's my great pleasure to moderate this second panel of the conference. We have learned already many things. We basically have now two schools of thoughts: those who think that the borrower-based measures are structural, and those who think they could be used in a cyclical way. In this panel, we heard basically two views and two countries that took action, loosened the borrower-based instruments during the COVID crisis, while one country didn't. So let me first ask the countries who did loosen the measures whether they thought that these actions were effective and necessary, and of course bringing that into the broader context of the COVID crisis. So we could perhaps start with Libor and then with Duncan.
Okay. So in our case, I would stress that we see those measures in the first line as a cyclical one. And at the beginning of the pandemic, we consider if to keep it, even if we can expect that the situation will change and banks will be very prudent in providing credits, and even the public will be prudent. And from this perspective, we thought that the market, as I mentioned, will work on its own. And in fact, in the first stage of the crisis, it happened, because we could see that the LTV banks were very stringent. And regarding DTI, DSTI, they were very prudent, because they didn't know exactly what industries and what employment will be somehow hit by the crisis. So at this stage, it fit to, let's say, loosen the condition and provide the market loans on its own. With retrospect, definitely we can say the prices are growing, the growth of credit is quite high. Maybe we shouldn't do it, but we don't have the structural issues, as Danish colleague said, or because the overall indebtedness is not such high, and the banking sector resilience and also household resilience seems also quite high.
Thank you very much, Libor. Do you want Duncan also to comment still these developments, the effectiveness and necessary of the actions at that time?
Sure. I guess it depends on your definition of effectiveness, but in terms of freeing up credit flow, it did seem to work in the way that was intended. Obviously, what we didn't anticipate was the degree to which the housing market would respond so quickly and with such strength. So, if it, and obviously hindsight's 2020, if it had been the case that the housing market had entered a severe downturn, and if, but to counter that, we had loosened the borrower-based measures and helped credit flow and potentially alleviate that correction, then I think you in retrospect would have said that was the right thing to do. I think in the end, it probably wasn't necessary what we did, aside from possible issues around the mortgage deferral scheme, but I think they could have been addressed in other ways. I think, again, with hindsight, I think it should have been on the table as an option to, certainly to loosen them, but perhaps we should have waited a little bit longer to see, what was developing, whereas we really, made the decision almost straight away when the pandemic hit. And I guess I did have one other thought, which was just, I think, I agree with Thomas that it's harder to put the restrictions in place and to tighten them than it is to loosen them and remove them. I mean, we did get them back in place, but it took some time. We had to do a whole consultation and regulatory impact assessment again from scratch, which we wouldn't have had to do, or certainly wouldn't have had to do to the same level of depth if we had kept the restrictions on, but maybe just eased the settings slightly, or just left the settings as they were until we saw what the developments were in the market.
Thank you very much. Actually, we have a question from the audience, which basically asks about the optimal action regarding borrower-based measures, as well as taking into account also monetary policy actions. So maybe if we leave it aside now, the COVID crisis, how do you see basically the tightening of the borrower-based measures and then the interaction with, let's say, expansionary monetary or fiscal policies? So how they can basically complement other policies, and how do they interact with other policies? And perhaps maybe Thomas, you could comment this.
Sure, I'll be happy to try to say a few words on that. First, in terms of monetary policy, then of course Denmark is a very special case here, because we have a fixed exchange rate towards the euro area. So our monetary policy is set by the euro area. So I think we don't tend to see to actually think a lot about how this would complement monetary policy. I think where we have some interactions with monetary policies, that now we import a very, very low interest rate, and then of course we have to think about if that would spill over to risks building up in the housing market. In terms of fiscal policy, I think it's quite important that we don't create the impression that borrower-based measures can substitute what you do in the fiscal space. For example, I mentioned in my presentation that currently the houses taxes is not linked to the current price level, so that they don't act as an automatic stabilizer. And here I think it's important to keep focus on that the best way to solve this problem would be to link taxation to house prices again. Then borrower-based measures is clearly a second best or third best solution here. But of course, sometimes you are forced into use borrower-based measures because you don't want to see systemic risk building up. But I think it's important that you don't put on more what should I say, more emphasis on these measures than they can actually bear.
Thank you very much, Thomas. Do you, Leiber or Duncan, do you want to add something about the interactions of the borrower-based measures with monetary policy and fiscal policy, more in general rather than in the current crisis?
I think I would agree with Thomas that we should keep keep a proportionate sort of view on what borrower-based tools can achieve. It's difficult when you're changing all these things at once, but I think it's pretty clear that it was the monetary loosening that was the key driver, potentially to some extent combined with the fiscal policy, that really was what kickstarted the housing market, and the borrower-based tools, I think, did play some role. But yeah, I think when you're talking about huge monetary stimulus and fiscal stimulus, I think we shouldn't we shouldn't claim too much for what the borrower-based tools can achieve. Yeah.
Thanks a lot, Duncan. Anything to add, Leiber, or do you want to come in here?
Hear me? You hear me. In our case, our monetary policy started tightening. So in general, I can say that if we tighten borrower-based measure, then the both policy will work together in tandem. Definitely in easing monetary policy, when we go, let's say, against, if we lose our macroprudential measures, then it can help to build up this, let's say, heating environment, what we see now. But we have to be very careful. And in our case, really, we have to consider what could be impact of relatively high interest rate differential to other currencies, to credit growth in a residential area. That's all.
Thank you very much. There is a question from the audience, which is asking about the balance of risks and benefits for the borrowers and for the banks regarding loan fixation periods of loans, interest rates on loans. So how do you see those effects of financial stability if there is a risk of rising inflation and potentially tightening of monetary policy? I don't know if anybody wants to come in, and then others can complement.
I'm happy to say a few words. So I think, as I mentioned in my presentation, New Zealand's mortgage market is characterized by relatively short fixed periods and quite a lot of floating as well. And, that certainly has worked well for borrowers, with the sort of secular trend of declining interest rates for, many years now. In terms of inflation, arguably with more people on shorter fixed terms and floating, then your monetary tightening, if you need it to combat inflation, should you should effectively get a bigger bang for your buck, because people are rolling off their fixed deals earlier, and although it's more risky for the borrower in that sense, but it also may mean that as a monetary authority, you can have more impact more quickly in terms of dampening inflation and consumption.
Thank you very much, Duncan. So, Thomas or Leiber, do you want to complement or?
Yeah, I'll be happy to. So of course, from the borrower's perspective, I think fixed rate would be the safest choice. And in Denmark, if we look at it historically, then fixed rate have been the only product you could get. Then you would only get 30-year fixed rate, and then we have had these shorter interest rates fixation periods coming later. And one of the main reasons in the Danish system, while I think that going for fixed rates is the safest option, is that we have this very, very special system where the mortgage is actually linked to a bond in the market, so that if interest rates were to go up, you can actually buy back your own debt at a lower cost. So you actually have an interest rate hedged.
In our case, the fixation periods are currently in average about 8 years. So in practice, it means that all portfolio is hedged for a relatively long time for certain repayments and interest rates. And the new loans, if it will be taken, then definitely there will be consideration about DTI, DSTI level age on the side of the bank. And definitely we will consider probable development of the rates in calibration, either of DTI or DSTI, if we would think about reintroduction.
Thank you very much. There is a very interesting question coming from the audience, where basically it's asking your experience of tightening borrower-based measures and the possibility of front-loading those measures. So before the actual measures come into force, so have you seen this type of front-loading happening? And basically, what would you recommend as an implementation period for new borrower-based instruments or new calibrations? So should they be done immediately or with some lead time? And maybe if Leiber, for instance, could start, and then the others could complement.
In the past, we did see front-loading in quite a big extent. It was in 2019 when we introduced DTI, DSTI, and this period was about 6 months. So therefore, definitely we think that it should be shorter. And in our current legislation, we are obliged for this period 4 months, which we seems at the end reasonable. Some front loading definitely will happen, especially when there are expectations if the measures will be reintroduced. But 4 months production is not such that it could cause some systemic problems.
Thank you very much, Leiber. Any comments from Thomas or Duncan? Any experiences?
So I think we have tended to front load considerably when we're tightening, partly because, well, obviously when we first implemented them, and then, in 2013, and then when we had to re-implement them this year, we had to do a full public consultation. That was a regulatory requirement. That takes time to do the consultation. And then the other issue that we found with the LBR restrictions is the banks, they like to have some lead time between when the settings are confirmed and when they actually have to start complying with them, because they have pre-approved loans in the pipeline and they don't want to go back to the customers and say, sorry, we said we'd give you this, but we can't. So we've tended to give them a couple of months lead time in addition to the consultation time. When we've been tightening, when we've been loosening, it's been much, much faster. And that's partly because the banks don't need any lead time, and partly because it's just less controversial to loosen, so you don't get pushed to do such a long consultation. I'm not actually convinced that that's the optimal outcome. I mean, that's sort of the way it has worked in practice. But I think particularly for loan-to-value restrictions, I think it would actually be better if you could get them in place sooner. Because if you don't get them in place until the market's already risen quite a bit, then one of the things that we've seen is that that's already freed up quite a bit of additional equity, particularly for investment property, for people leveraging their existing property. So then sort of playing catch up on that front. But I'm not sure exactly, I think we can potentially look at ways we could shorten the consultation period, but there's always still going to be the lead time with the implementation. So it's not optimal, but sometimes it's difficult to see how we can. I'm sure we could shorten the time, but it seems like it will inevitably be longer on the tightening than on the loosening.
Thank you very much, Thomas.
Yeah, I also think in the case of Denmark, where it takes some time to implement these measures, we have to do a recommendation, and then the government have to consider if they want to follow the recommendation, and then it has to be actually implemented. I think one thing we have discussed a bit is that if you publicly announce that you would restrict some risky mortgages, then there's a risk that people doing this period from the announcement until it's actually implemented would choose to actually hoard these products. But I don't think we have seen any strong evidence that this is actually taking place.
Thank you so much for all your insights, dear panel. I think we learned again a lot. It has been a true pleasure to chair this panel, and as mentioned by the governor, the timing of the conference is essential given the planned changes or proposals for changes of the legal framework here in the EU regarding borrower-based measures. So we are very much looking forward to the continuation of discussion, and congratulations to the organizers, and thank you very much.
Dear Thomas, dear panelists, thank you very much. In addition to that, I would like to thank the speakers of the first panel as well. And with that, we are closing today's sessions. We are not closing the conference just yet. I would like to invite everyone to meet again tomorrow at 9 a.m. Vilnius time, when we will resume with our conference. And tomorrow we'll be touching upon some other interesting topics, such as climate risks and how the borrower-based measures could be used to mitigate this risk, as well as some side effects of the borrower-based macroprudential policy measures in terms of inequality and other distributional effects. And in addition to that, it is my great pleasure to pronounce the presence of yet another honorable guest, Mr. Sharon Donnery, who's a Deputy Governor of the Central Bank of Ireland, and she will be giving a keynote speech tomorrow. So thank you very much once again. I'm not saying goodbye just yet, and I invite you to meet tomorrow at 9 a.m. Bye-bye.